Hello dear students, my name is Maulin Kadikar. On behalf of Navkar Digital Institute, I welcome all of you to the revision section of financial management. Dear students, we are going to have a quick revision of the individual topics from our examination point of view. Starting first of all with the examination paper style. As we understand that, there are total 6 questions that we have in examination from the financial management, that is section A. Total 6 questions will be there. As far as the question number 1 is concerned, it is a compulsory question which is consisting of the 4 questions, each of them carrying 5 marks. And all of them are practical questions. Question number 2 to question number 6. There are 5 questions and we have to attempt any 4 questions out of these 5 questions. So what will happen? 10 marks from each of this question, 40 marks plus 20 marks first compulsory question, 60 marks is the examination paper that we have. Usually in question number 2 to question number 6, we have question number 2 to question number 5, practical questions, and the last question is of the theory question. The theory question is divided into 3 parts. It is A, B, C. The marks weightage is like 4, 4 and 2, or otherwise sometimes it is 3, 3 and 4 also. May 18 was only examination paper in which the question number 2 was divided into 2 parts, 8 marks and 2 marks. 8 marks was practical question, 2 marks theory question. Dear students, the thing for which you have to take care is that considering the examination paper trend that we have right now, you can skip the entire theory. This is what you have. Yet, usually 2, 3, 4, 5 from one of these questions, I have usually observed that one of the question is difficult, one of the question is very difficult for student to apply. In that case, the theory will save you. There are 3 questions that we have of the theory, and if at all you are able to solve even 2 questions, or if at all you can write answers even for 2, then focus on those 2 questions rather than attempting a question for which you are not very confident. The practical questions are having the high risk and high return. Why? Because even there is a computational error in the initial steps, and later on, if at all that answer is going to be considered for the subsequent questions, that is the subsequent steps, then in that case, if at all you have made any mistake earlier, no marks will be given later on. And I tell you that in theory also you will be given full marks if at all you have written to the point and you have written correctly. Grammatical error or spelling error is also not an issue from examination point of view that we have. So the first thing is the examination paper style. The second thing that I want to tell you is this, that as a student you cannot break the internal sequence. If at all I want to start with question number 5, I can. 5, 3, 2, 1, 6, like that I can do it. So basically there is no rules and regulations that say in which sequence you have to write the answers. However, if at all I start with, let us say question number 6, in which they have specified A, B and C question, then that internal sequence I cannot break. I have to write A, 6A, 6B and 6C. That is the way I have to write it. If at all I write 6A, 6C and then 6B, then for 6B, no marks will be given to me. So that internal sequence is something important. Question number 1A, 1B, 1C, 1D, that is the only way you have to write the answers. This is what for which you need to take care. My usual suggestion is, do not start with the compulsory question. The reason is that sometimes a compulsory question is a very simple question, however it may consume too much of your time. The second thing that we understand is that as far as compulsory question is concerned, apparently you may feel that it is very simple, but internally they might have kept say some very complicated point for which you may not have done practice. So generally I suggest students not to start with the first question, that is a compulsory question. Here is the index of module. Chapter number 1, scope and objective of the financial management. Second is types of financing and so on. Dear students, as far as the first chapter is concerned, it is entirely theory. Second chapter is entirely theory. Rest all the chapters are having the combination of the theory and practical. There are 9 chapters and the 10th chapter is divided into 6 units. So we can say it is 9 plus 6. Like that, so there are total 15 chapters that we have. Out of these 15 chapters, we can say that management of the inventory is a very simple chapter which is covered in your costing. So we can exclude management of the inventory. So if at all I exclude it, then in that case, there are 14 chapters that we have. As far as these 14 chapters are concerned, that is again divided into 2 parts. As per my understanding, there are 2 chapters which are purely theory. There is not at all a single practical question from it. And so the remaining 12 chapters are chapters in which we have a combination of the theory plus practical. This is what we have. So this is the way we have the bifurcation of these 15 chapters. One is like the inventory management, which you have done it in your costing very much in detail. There are very few questions. One is about the EOQ, another is about the stock out, then reorder level. Very simple questions are there, which you have covered in detail in your costing. Remaining 14 chapters divided into 2 parts, 2 chapters pure theory, and the remaining 12 chapters have the combination of the theory and practical both. This is what we have. Usually, not always. The question number 6, which is the theory question, is from the first and second chapter, that is a pure theory chapter. Usually, not every time, because of course there are questions from the theory chapters and practical chapters as well. That is a combination of both of them. I would like to start with the revision with the chapter number 3, that is the financial analysis, planning, ratio analysis. So chapter number 3 is financial analysis, planning, ratio analysis. Dear students, first of all, having a small discussion about the chapter. We understand that the term ratio is basically indicating a kind of outcome based on which you can have some interpretation. For example, when you see that the current ratio, then in that case we understand it is indicating that what is the current assets for every 1 rupee of current liability. When you observe the debt equity ratio, it is indicating the proportion of the debt for every 1 rupee of equity. And so on, we have the ratios. There are 2 things that we have. One is the computation of the ratio, another is the interpretation of the ratio. And of course, the ratios are indicating the financial health. With that, we can understand that what is the financial position of the company that you can measure with the ratios. Further, we have something like preparation of the financial statement using the ratios. This we can say is very similar to what we study in the single entry in accounts. Dear students, right now as I am focusing from examination point of view, I would like to tell you that most of the questions, if at all you check in the recent time, then they are from the missing information only. Certain set of the information will be provided to you, and based on that you are required to complete the financial statement. Certain set of the information is given to you, and based on that certain values are required to be calculated by you. So this is something on which you should focus from your revision point of view. That is the first thing. Second thing that I understand is that you should have an idea you should have an idea about the individual ratios, and say you should be able to say convert this information into say the financial statement. These are the two things that say you should be aware of. One is the individual ratio, and the second is based on this ratio you should be able to convert the same say into financial statement. These are the two things. Dear students, here is a list of the certain ratios which are included in your syllabus, and say I have prepared over here say a small summary that say from each of the concept what was the marks allocation. Like over here the ratios are current ratio, liquidity ratio, working capital, gross working capital, absolute cash ratio. Like that, so these are the ratios which have been included in our syllabus. You can see that say most of the time the individual ratios are not asked upon. Return on capital employed, it was asked upon, earning per share, then price earning ratio, and so on. The individual ratios are there. Then preparation of the financial statement. For that, say the 5 marks, then return on equity and missing information. We can observe that say it is like the every time the 5 marks question is there from the ratio analysis, on an average 5 marks are allotted say to this chapter. I would like to discuss with you like a few formulas and a few things which are important from examination point of view. Starting with quickly say a few formulas. The first is the absolute cash ratio. Dear students, absolute cash ratio is indicating what is the cash and cash equivalent available with the company for making payment of 1 rupee of the current liability. Always remember that say whatever is there in the division, for making payment of that 1 rupee or for every 1 rupee of that value, what is the value is indicated in the numerator. Cash reserve, that is simple language, it is cash and cash equivalent. It will include the cash balance, bank balance, and short-term marketable securities are required to be included at market value. This is not the ratio which is tested for number of times in examination. These are the rare ratios which are there. Then the cash position to the total assets ratio. It is again the cash reserve divided by the total assets. Remember that say the total assets, sometimes the old balance sheet format is given to us. In that say if at all we have been provided with any miscellaneous expenditure not written off or debit balance of the profit or loss account, then in that case it is required to be deducted. Logically speaking, we understand it is not the asset that the company has. Cash interval is basically calculated in terms of number of days. It is indicating that say what is the cash and cash equivalent available with the company for meeting with the day-to-day expenses. Over here, for cash interval or for the difference ratio, an assumption is made that the annual expense of the company is evenly spread throughout the year. Suppose the annual expense of the company is 3,65,000, just for example. There are 365 days in a year, then daily expense will be 1,000. Suppose we have the cash reserve of rupees 10,000. Then 10,000 divided by 1,000, it is indicating 10 days. It shows that say whatever the amount of the cash balance that I have, with that say you can pull on your business for another 10 days even though you have no any further cash accrual. The cash accrual in form of sale of the goods or on collection of the debtors. By any way, if at all you are not receiving the cash, then this is indicating the number of days for which you can pull on your business. Current ratio, that is current assets upon current liabilities. That portion of the assets of the company which can be converted into cash within 1 year is considered to be the current assets. That portion of the liability of the company which is required to be paid within 1 year is considered to be the current liabilities. If at all we have been provided with the income tax information and tax provision, then in that case, advance tax can be considered as the current assets, and income tax provision can be considered as the current liability. Or otherwise, say you may make net of both of them, and accordingly also you can make the calculation of answer. See over here, the institute would not be like so much conscious say with the individual answer. They would be more conscious say with respect to the logical working or the conceptual working that you show. As far as the quick ratio or acid test ratio or liquidity ratio is concerned, in that say you just remember that from the current assets you have to eliminate the prepaid expenses. You are required to eliminate say the stock divided by the current liability. As far as the current liability is concerned, in that say if at all bank overdraft is included, you don't have to subtract it. Be careful that say this is a kind of clarity that the institute has given. Proprietary ratio, in that set is proprietary fund upon the total assets. We understand like this, in case of proprietary ratio, you have to visualize the balance sheet. In the T format, the assets of the company are, let us say, 10,000. Of course, if at all again miscellaneous expenditure not written off or deferred revenue expense, not, that is a deferred expenses not written off, they are not required to be considered as a part of the current assets. And over here the proprietary fund. So proprietary fund upon total assets is indicating say the proprietary ratio. As far as the proprietary fund is concerned, that you are required to understand broadly. It is equity share capital paid up value, security premium, preferential capital, reserves and surplus. And dear students, all reserves and surplus are required to be considered. You do not have to eliminate any reserves and surplus. Any debit balance of the P&L account, it means loss, or any miscellaneous expenditure not written off will be subtracted in computation of the proprietary fund. Dear students, the proprietary fund itself is the equity and the proprietary fund itself is the net worth. Total liabilities to net worth ratio, it is the total liabilities divided by net worth. Total liabilities means so the liability to outsiders. Okay, the total liability stands for liability to the outsiders. It means that it include long-term liability as well as the short-term liabilities. That is what we understand is the total liabilities to net worth. Debt equity ratio, in that is the debt upon equity. As far as the equity is concerned, I have already explained to you that the proprietary fund, net worth and equity are one and the same. Now, as far as the debt equity ratio is concerned, in that, be careful friends, sometimes the clarification is made in the question that the debt is required to be taken as long-term debt. Debt is required to be taken as the total debt. If at all such kind of clarification is made, then accordingly you will do answer. But if at all such kind of clarification is not made, then in that case, so you have to put a note that say what you have taken. This is the way you are required to find the debt equity ratio. If the question says that say compute the financial leverage ratio, then in that case the financial leverage ratio will be calculated taking long-term debt into account. This is what we are required to do. Then set is the capital gearing ratio. As far as the term gearing is concerned, gearing means introduction of the leverage. It means introduction of the committed sources of finance. So it will be calculated as extension of the debt equity ratio. Like that, so you can remember that from equity, preferential capital is transferred from denominator to the numerator and you get the capital gearing ratio. So what happens at it is the debentures plus say the preferential capital. Debentures or any other long-term debt. This is including only the long-term debt. Short-term debt is never included in the capital gearing ratio. Divided by equity, and that equity includes like the equity, security premium, all reserves and surplus, minus debit balance of P&L account, minus miscellaneous expenditure not written off, and so on. Return on net worth, that is so the return upon net worth, that is earning after taxes upon net worth. Earning per share, it is earning available to equity shareholders divided by number of shares. Earning available to equity shareholders will be calculated as earning after taxes minus preference dividend. Then interest coverage ratio. Interest coverage ratio is indicating what is the ability of the company for making payment of the interest out of the operating income. Whatever the operating income that the company has, out of that, say what is the ability of the company for making payment of interest is calculated by interest coverage ratio. It is EBIT upon interest. Now friends, you have to go logically. Let's say, if at all the question says that you are required to compute the preference dividend coverage ratio. Whenever you are required to find any coverage ratio, then in that case, this financial charges will be forming part of the division. So the preference dividend will come in the division. And what will be the numerator? Dear students, numerator is earning after taxes. Why? Because preference dividend is paid out of earning after taxes. So whatever the value from which the payment of the financial charges is made becomes the numerator, and that financial charges will become the denominator. Similarly over here, it is EBIT upon interest. Why? Because the interest is paid out of EBIT. If at all we are required to calculate equity dividend coverage ratio, then in that case it is earning available to equity shareholders divided by equity dividend. And earning available to equity shareholders is calculated as earning after taxes minus preference dividend. That is the way, so the equity dividend coverage ratio is required to be calculated. We understand logically that, say, had the coverage ratio is indicating good financial position of the company and vice versa. This is what we understand. Debt service coverage ratio. Dear students, as far as the interest coverage ratio is concerned, it is measuring the ability of the company for making payment of the interest only. However, we understand that, say, from the bank point of view, the bank is interested to know what is the ability of the company for making payment of interest as well as the preference dividend. That is, as well as the repayment of the principal. That is the reason, so the debt service coverage ratio is calculated. See over here, you read the name of the ratio. Debt service means servicing of the debt financing. That includes two things. One is the interest and another is principal. So the debt servicing, it is from what? From, say, the funds which is available for servicing the debt financing. It is calculated as profit after taxes plus depreciation. Why? Because we know that depreciation is a non-cash item. Plus any other amortization. Then any other amortization will be again added. Like goodwill return off or like any other preliminary expenses return off, that will be added. Importantly, so the interest is added to it. So we understand that, say, the interest is added to the numerator. Why? Because the interest is part of the division. That is the reason, so the interest is added to the numerator divided by interest plus principal amount. A small important point, usually they do not test it. However, a small important point I would like to tell you. Suppose the 5 lakh rupees is the principal amount which is due during the year. Then that 5 lakhs is required to be taken over here for the purpose of calculation of the ratio, and not the principal amount which has actually been paid. It may be more than 5 lakhs or less than 5 lakhs, but theoretically the ratio will be calculated using 5 lakhs. Raw material turnover ratio. As far as the raw material turnover ratio is indicating that how many times there is a rotation of the raw material in a year. That is what the raw material turnover ratio is indicating. Suppose, so the annual consumption of the raw material is 12 lakhs and we keep usually the stock of 1 lakh, then turnover ratio is 12 times in a year. Here the turnover ratio is indicating that, so the company is able to utilize the raw material fast. That is what the raw material turnover ratio. It is raw material consumption upon average stock of raw material. One clarity that I want to give you over here is this. Remember that, so there are 3 types of ratios that we have. One is the type of ratios wherein we use only balance sheet information. For example, we are required to make the computation of the debt equity ratio. We are required to make the calculation of the current ratio and so on. These ratios are required to be calculated using some balance sheet information. Over here, there is never average comes. It is only the as it is value you are required to take for the purpose of calculation of the ratio. Next is the ratios which use trading account and or profit or loss account information. For example, we are required to calculate the gross profit ratio. We are required to find the net profit ratio, or any expense ratio is required to be calculated. Whenever we are required to find these kind of ratios, even in that case, there is never average that you have to take. However, when there is a combination of these two values, that is, one value is from the profit and loss account or trading account, and the second value which you have is from balance sheet. Then in order to have the better understanding of the ratio, so as far as the balance sheet information is concerned, it will be taken as average. Dear students, we understand that, say, for example, asset turnover ratio is calculated as sales upon assets. This ratio is indicating that, say, what is the ability of the company to use the assets of the company for generating the sales. Now, at the beginning of the year and at the end of the year, what happens is, say, suppose, say, in the month of March, you have purchased a fixed asset. Huge fixed asset has been purchased in the month of March. Now, understand it logically. If at all you take into account only the closing assets for the purpose of calculation of the ratio, then in that case the ratio will be too less. That is indicating that, say, the company does not utilize the assets properly for generating sales. Actually, the assets which have been acquired in the month of March, that has not contributed, say, during the year for generating the sales. That is the reason, say, for the balance sheet item, we take the average. This is a general rule that we have. Now, number of times what happens, friends, that, say, the sufficient information is not there with which we can take the average value for the purpose of doing answer. Then in that case, looking to the situation, we are required to make the calculation of answer. Raw material consumption is very simple. Opening plus purchase minus closing. The purchase may be cash, purchase may be credit. Either of that we are required to consider. Average stock is opening plus closing divided by 2. Then raw material holding period. It is indicating the time period for which you hold the raw material before it is issued for production. That is raw material holding period. So numerator is 12 months or 360 days or 365 days or raw material turnover ratio, or otherwise 12 months, 360 or 365 days divided by annual consumption into average raw material stock. WIP turnover ratio, in that it is the cost of the production, that is works cost, divided by average WIP. As far as the cost of the production is concerned, it is the prime cost, that is the direct material plus direct wages plus factory overhead plus opening WIP minus closing WIP. Similarly, the WIP holding period, that is indicating the production time period. It indicates that, say, what is the time period in which the raw material is getting converted into finished goods. So it is calculated as number of days or months in a year divided by WIP turnover ratio. Or you can have the alternative formula. Again, had the WIP turnover ratio is indicating that, say, you are able to get the production faster, which is a good sign. Finished goods turnover ratio, it is calculated as COGS upon average finished goods. COGS is cost of goods produced plus opening minus closing. Again over here we understand that say it is indicating that say what is the rotation of the finished goods inventory, that is what the finished goods turnover ratio is indicating. In a year, suppose the cost of goods sold is rupees 36 lakhs and we maintain the finished goods equal to 3 lakhs. Then this 3 lakh rupees of the stock will be sold. Again we will produce or purchase. Sold, produce or purchase. That rotation takes place for 12 times in a year. That is what this indicates. Finished goods holding period, that is indicating the time period for which we hold the finished goods before it is issued, that is before it is sold to the customer. It is number of days divided by finished goods turnover ratio or number of days divided by COGS into average finished goods. Then debtors turnover ratio, which you study for number of times. It is annual credit sales upon average debtors. Be careful that you are required to take only the credit sales. Average debtors is opening plus closing divided by 2. Average collection period is 12 months or number of days in a year divided by debtors turnover ratio, or you can apply this formula. Debtors turnover ratio is indicating number of times that there is a rotation of the debtors in a year. Suppose the debtors turnover ratio is 6 times in a year. It is indicating that whatever the debtors that you have, from that you collect the amount. Again those debtors are created. You collect the amount. Again those debtors are created. That rotation takes place for 6 times in a year. Collection period is indicating simply the credit period, that is indicating the time period in which you are able to recover the amount from your customer. Net profit ratio, it is net profit upon sales into 100. That is the way it is calculated. Raw material expense ratio, it is raw material consumption upon sales into 100. Direct wages expense ratio, direct wages upon sales into 100. Indirect expenses ratio, it is indirect expenses upon sales into 100. Working capital turnover ratio, it is sales upon average working capital. Remember that say, when the question says that say the working capital ratio means current ratio. Working capital turnover ratio means sales upon average working capital. That is indicating that say for every 1 rupee of the working capital investment that you have in the business, what is the sales that you are able to generate. Fixed asset turnover ratio, again sales upon average fixed asset. We understand that so that is indicating that for every 1 rupee of the fixed asset that you have in the business, what is the sales that you are able to generate. Working capital is current assets minus current liabilities. GP ratio is gross profit upon sales into 100. Then fixed asset to proprietary ratio, that is what's one of the ratio which may be provided. Fixed asset upon proprietary fund. Then the return on capital employed. Now as far as the return on capital employed ratio is concerned, I tell you friends something like this. Understand this very importantly, because this is what's one of the gray area in which I have seen that students are committing mistake. Or we can say that the suggested answer of the institute have some differentiation. See, when the question is asking about return on capital employed or return on investment or a return on asset, when any of these ratios are asked upon, they should provide further clarity that whether it is required to be found on pre-tax basis or it should be calculated on post-tax basis. That kind of clarity should be there. As I told you that say when we are required to make the computation of the debt equity ratio, then debt is to be taken as the long-term debt or debt is to be taken as the total debt. For that say number of times clarity is not there. That clarity should be there in the examination paper. Similarly, for these ratios, clarity should be there whether it is to be found on the pre-tax basis or post-tax basis. If nothing is specified, you do answer with one of the method and you put a note for the same. That is the first thing. Second thing, as far as the capital employed is concerned, for that, say there is a clear, like the clarity that we have. As far as the return is concerned, it is, if it is pre-tax, then earning before interest and taxes. If it is post-tax, then into 1 minus t when it is post tax. That's okay. Now, as far as the capital employed is concerned, capital employed means all long-term sources of finance together. That includes equity share capital, preference share capital, all kinds of reserves and surplus, all kind of long-term financing. That is what we understand is included in capital employed. As far as the return on investment is concerned and the return on asset is concerned, they use the same values for the purpose of doing answer. So accordingly, you are required to make the calculation. Of course, if at all the debit balance of the P&L account or miscellaneous expenditure not written off have been given, then in that case it will be eliminated for the purpose of say making calculation of answer. This is the way we are required to calculate the answer. Yes, students, remember that so the current ratio has another name as the working capital ratio. Okay. Quick ratio itself is the liquidity ratio, itself is the asset test ratio. The term gross working capital means only current assets. It means only current assets. Sometimes the question is asking about calculate the dividend yield to investor or gross dividend percentage. Then in that case it is dividend per share upon market price of the share into 100. This ratio is calculated from investor point of view. Then we may be provided that to calculate the earning yield to the investor. Then in that case it will be calculated as EPS upon MPS into 100. That is what is the return to the equity shareholder in terms of the earning. Then as far as the price earning ratio is concerned, it is calculated. The price earning ratio is calculated as market price of the equity share upon earning per share. Gross yield percentage is indicating what is the return to the equity shareholder in terms of the dividend income. Earning yield ratio is indicating that say what is the return to the investor considering earning as a return to the investor. Price earning ratio is indicating that say what is the market value of the equity share for every 1 rupee of the earning per share. Suppose the price earning ratio is 10. It means that so the market value is 10 for every 1 rupee of earning. The term net fund flow is asked sometimes. As far as the net fund flow is concerned, it is calculated as earning available to equity shareholders minus equity dividend. So that will give us retained earning plus depreciation. Why? Because it is a non-cash item. That is the way so the net fund flow is calculated. Friends, recently in November 18 examination of IPCC, there was a question in which they had asked about the DuPont model. So just remember that so the DuPont model, in that say we are required to apply the formula like this. It is net profit ratio, which is net profit upon sales, multiplying with the asset turnover ratio. It is sales upon assets, multiplying with something which is important, that is called equity multiplier. So it is assets upon equity. So ultimately this ratio is nothing else but say it is a kind of a return on net worth. Why? Because so the sales is cancelled, assets are cancelled. So it is net profit upon equity. But this is something which is like importantly you need to understand. I just give you a small explanation. Suppose this asset upon equity is 3, means every 1 rupee that say you introduce of the equity, assets of the company increases by rupees 3. Suppose asset upon sales upon asset is 0.90. Suppose, what does it mean? For every 1 rupee of the asset that you have in the business, with that say you are able to generate the sales of 90 paise. So 3 into 0.9, that comes to 2.70. And suppose the net profit ratio is 12%. Then for every 1 rupee of the, say the sales that you have is generating the profit of 12 paise. So 2.7 into 0.12, that comes to 0.324. I'm just taking assumed values. So this is the way we understand that say every 1 rupee of the equity that you introduce in the business, what is the profit that you are able to generate, that is what this ratio is indicating. The last thing which I want to tell you about the ratio analysis chapter is this. Dear students, taking into account the IPCC, November 2009 onwards the papers and intermediate all papers, I am telling you that say a few questions which have been asked in examination in form of theory questions. There are these 4 questions which have been asked. In November 2009, it was question number 5I which was asked. That question was, say, explain briefly the limitation of the financial ratios. So what are the limitations of the financial ratios? That was the question which was asked. We understand that limitation of the financial ratios are like this. The first is diversified product lines. Financial data are badly distorted by the inflation, seasonal factors, window dressing, different accounting policies and accounting period, no standard set of the ratios, difficult to generalize whether a particular ratio is good or bad. Financial ratios are interrelated and not independent. And students are required to write any 4 limitations. Dear students, when you refer the theory, say from the suggestions, then in that case you can come to know that what kind of expectation that they have in terms of writing the content. In May 2011, it was question number 7B which was asked. The question was explain the following ratios. One was operating ratio and another was operating expense ratio and another was price earning ratio. Operating expenses are indicating that those expenses which we are required to do for the purpose of running business. That is operating expenses upon sales into 100. Price earning ratio, just now I have discussed with you, MPS upon EPS. May 2012, question number 7B, that was a question which was asked. Explain the important ratios that would be used in each of the following situations. So the question is that say a few situations have been provided to us and we are required to answer that which ratios will be used for these ratios. We have been provided with the 4 different ratios, that is the situations in which we are required to answer that which ratio must have been used. And then May 2014, in that say, comment on DSCR. What I want to tell you friends is this, that whenever you are doing, say, the theory from the practical chapters, I think that say doing theory is becoming very simple for you. So always make sure that say, from your examination point of view, that say you are having a clarity, say with respect to these things, and writing answer in your own language, you'll get the full marks. Let us start with the 4th chapter. 4th chapter is cost of capital. First of all, let us focus on the scanner. Considering that say the earning per share, financial indifference point, financial break-even point, all these concepts are very much connected with the cost of capital, this scanner is prepared. So we have the different concepts like this: earning per share, then financial indifference point for a new business, then financial break-even point for a new business, then financial indifference point for an existing business, again the break-even point for existing business. So these are the concepts which are related to the capital structure theories, which I think that's very much connected with the cost of capital. Then the core cost of capital concept starts. That is, cost of perpetual debt means the securities issued for perpetuity. For that, so the cost of debt financing. Then cost of perpetual preference share, that is the concept. In case of debentures, in case of preference shares, we have the concept that these securities are issued for perpetuity. Then cost of redeemable debt and cost of redeemable preference share. In that say, we have practically the situation wherein the security is redeemable in nature. Then financial indifference point between the debt and the preferential capital plan. This is something important that we have, because between the debentures and the preference shares, there is no financial indifference point in certain situations. Then issue price of the security from investor point of view. Then growth rate in the earning and dividend, because this is going to be relevant for calculation of the cost of equity. Next, cost of existing equity shares with no growth. Next, cost of new equity share with no growth. Cost of existing equity share with growth information. Cost of new equity share again with growth information. Cost of retained earning. Cost of equity using CAPM. Cost of existing debenture. Cost of retained earning when percent tax rate information is given. Weighted average cost of capital with book value approach. Weighted average cost of capital with market value approach. Weighted average cost of capital for additional financing, and the concept of the trading on equity. We can say that these are the broad concepts that we have, say in case of cost of capital calculation, in case of cost of capital chapter. Dear students, we can see that say the questions which have been asked in November 18 is of 5 marks, May 19 is of 10 marks from earning per share calculations. So the total it is 15 marks. Then financial indifference point, 5 marks question. Then weighted average cost of capital concept has been tested in examination for 5 marks, 10 marks. So the total comes to 15 marks. So the total marks 35 and average is 8.75. This is the average marks which have been asked considering the financial plans question as a part of the cost of capital. Now I am talking about the first segment, that is a financial indifference point, financial break-even point, that segment. And in that, say, first thing that say you are required to make the computation is the earning per share. Dear students, these kind of questions are divided into 2 parts. We will be provided with a new entity, or we will be provided with the information about an existing entity. If it is new entity, then in that case, what will happen? Let us understand. We will be provided with the information that say there is a requirement of the funds. Let us say an amount of funds of rupees 10 lakhs is required. So either we are going for 100% equity financing, we are going for the equity and preferential capital, that is financing combination, equity debenture combination, equity preferential debenture combination. Like that, say certain financing alternatives will be provided to us. For each of the financing alternative, we'll make the calculation of the earning per share. How we will make the calculation of EPS? That is very simple. We will be provided with the information, say, about the operating income. From operating income, we will deduct the interest, that is the financial charges. We'll get the earning before taxes minus income tax. We'll get the earning after taxes. From that, the preference dividend is deducted. We get earning available to equity shareholders divided by number of equity shares will give the EPS. That is the way we will make the calculation of the earning per share. Always remember that say there may be multiple financial plans. However, based on the financial plan, always say the EBIT is supposed to be same. The EBIT value will not change as per the financial plan. Because whatever may be your financing pattern, your operating income, your efficiency of the doing business is always going to remain same. This is what we understand is the way earning per share will be calculated. Next is the concept is say about the financial indifference point. Financial indifference point is calculated by using a formula like this. We understand that so the EPS of A financial plan is equal to EPS of B financial plan. Suppose between two financial plans we are required to find the indifference point. Then EPS is calculated like this. EBIT minus interest is EBT into 1 minus C is EAT minus preference dividend divided by certain number of equity shares. This is EPS of the A financial plan is equal to the EPS of B financial plan. That is the way we'll make the formula, and this EBIT value is supposed to be calculated as balancing figure. That is the level of the operating income at which EPS of both the financial plans are same. The next concept that we have is called financial break-even point. Financial break-even point means the level of EBIT at which EPS is 0. It is calculated as amount of interest plus preference dividend divided by 1 minus T. It is indicating the level of EBIT at which the EPS is 0. The term break-even point stands for a situation where there is no profit, no loss. And this is calculated from the equity shareholders point of view. Now suppose friends, there are two financial plans that we have. Financial plan 1 and financial plan 2. Let us assume that the financial plan 1 is the entire equity plan. The financial plan 2 is equity plus debt plan. Then in that case, we will have a kind of diagram like this. On x-axis, it is like the independent factor is taken, earning before interest and taxes. And on y-axis, we take the dependent factor that is called earning per share. Now, this red line is indicating the financial plan 1. This red line starts from 0. What is the significance of that? The significance is that say, in case of entire equity plan, the financial break-even point is 0 because there are no fixed financial charges included in that. With the increase in the EBIT, EPS increases. This is the financial plan 2, the black line which is shown over here in the diagram. This is the financial plan 2, which is the combination of the equity and debt. Dear students, this plan starts from somewhere here. Why? Because unless you are able to earn equal to the interest amount, you will not be able to reach to the financial break-even point. So this is the financial break-even point for the second financial plan. That is the starting point of the diagram. What happens at we can see at this point of time, so there is intersection between the first and the second financial plan. The intersection between the first and second financial plan is given a technical name as the financial indifference point. Financial indifference point means the level of EBIT at which EPS of both the financial plans are same. That is what we understand. So friends, what happens at this is the level of EBIT at which EPS of both the financial plans are same. This is what we understand. Now what is the significance of this financial indifference point? The significance is like this. When expected EBIT is less than the financial indifference point, that is anywhere over here, if at all the EBIT is falling, then in that case, so the financial plan 1 is going to be better than the financial plan 2. For the same level of the EBIT, the first financial plan will be able to generate higher earning per share. This is what we can observe. This is the significance of the financial indifference point. Above financial indifference point, the financial plan 2 will be able to supersede the financial plan 1. So we have over here a situation like this, in which we understand that the financial plan 2 is better than the financial plan 1. This is what we understand here. So this all calculations or this all analysis are helping us to decide that which financial plan to be selected based on expected EBIT. So if expected EBIT is greater than the financial indifference point, then in that case, friends, we should select the financial plan 2. If expected EBIT is less than the financial indifference point, then in that case, we should select the financial plan 1. If both of them are same, then in that case, say they are indifferent. That is, the company is indifferent whether to select the first financial plan or to select the second financial plan. That is what's the kind of analysis that we make. Whatever I have said over here between first and second financial plan, in that the second financial plan is the equity and debentures. Instead of equity and debentures, had there been equity and the preference shares, the conclusion is going to remain same. Equity debentures. Whatever the conclusion that we have, equity preference shares, the conclusion is going to remain same. That is what we understand. Now over here, importantly, what happens at say, sometimes we are provided with the information. Listen carefully, this is important. Sometimes we are provided with the information, say about the equity plus debentures and equity plus preferential capital. That is the way we are provided with the two financial plans. And importantly, in that case, the amount of the debentures, amount of the preferential capital are same. Rate of interest and the rate of preference dividend are also same. That is the kind of situation which is provided to us. Dear students, in that specific situation, we have a diagram like this. As far as the red diagram is concerned, so it is about the equity plus debentures. And black, it is equity plus preferential capital. Importantly, what happens at say these two lines are going parallel. That is indicating that say, the equity plus debt plan is always better than the equity and the preferential. Dear students, the reason for that is, as far as the equity plus debenture is concerned, in that say, always you get the advantage of the interest tax saving, which advantage is not there in case of the preferential capital. That is the reason, so the equity plus debenture plan is always superseding the equity plus preferential plan. In examination, you have to just make sure that the conditions are that one, amount of the equity financing is same. Second, the amount of the preferential capital and the debenture value is same. And the third is cost of debt financing, that is post-tax cost of debt financing is lower than so the cost of preferential capital financing. In that specific situation, something like this happens and you are required to write the answer of the financial indifference point, in which on both the sides the value of the EBIT will get cancelled. So there is no financial indifference point between these two financial plans. Now friends, whatever I have made a discussion over here, the entirely same discussion is applicable if at all a company is going to expand its business. In that case, what happens at say, in making calculation of the earning per share, you are required to take into account the interest in total. We will take into account the existing interest and at the same time we will take into account the new interest. That we will consider for the purpose of making calculation of EPS. If at all there is any preference share capital the company which has issued right now, then in that case even in the preference share dividend will consider both existing as well as new. For number of equity shares, we will consider existing number of equity shares and we will consider the new number of equity shares which the company is going to issue. Both of them will be taken into account for the purpose of EPS calculation. So over here we are required to do the similar working, however it is with respect to the expansion of the plan. Over here the options which will be provided to you may be anything. It may be only debt, only preference share capital, only equity shares. Like that, so you will be provided with any of the information. In addition to that, remember that say in respect of the equity shares, we are provided with the issue price which may be at premium. In that case, what is the issue price of the security, and with the change in the financing, that is say the change in the debt financing proportion, there may be a change in the issue of the, that is issue price of the equity share. Whatever this kind of information that will be provided to us will have to be taken into account for the purpose of say the earning per share calculation. This is what say the entire different segment that say we will have for EPS calculation. Financial break-even point and financial indifference point calculation. Importantly, we are making this calculation for a company as a whole. That is the reason we are required to take into account not only the existing financial charges, at the same time we are required to take into account the new financial charges for the purpose of making calculations. Again the formula for financial indifference point, again the formula for financial break-even point, everything is going to remain same. Now, as far as the cost of capital is concerned, we are starting with that segment, the core segment of the cost of capital. First of all, I would like to discuss with you the reason that say why do we make the computation of the cost of capital. Dear students, as far as the term capital is concerned, the term capital stands for the funds. Whatever the funds that we raise for the purpose of doing business, that is considered to be the capital. And we are going to make the computation of the cost of raising the funds. This is what we are going to calculate. Basically what happens as a company, we make investment in the different investments. We make investment in the fixed asset, we make investment in the trade investment, we make investment in the working capital, and with that we do business. So these are the investments that we make in the business. Whatever the investment that we make in the business, that amount is financed from the different sources. We raise the funds by way of equity financing, by preferential capital financing, by debt financing, and so on. Of course, we understand that the rate of interest, rate of preference dividend, rate of equity dividend is not going to be same. Yet, we understand that all these sources of funds have some cost. Whatever the business that we are doing, that business is supposed to give a return, so that we can give return to these finance providers. We have a commitment for giving interest. We have a responsibility for making payment of dividend. Whatever these responsibilities that we have created, so for discharging those responsibilities, we are required to earn from the business. So over here the intention of the chapter is that to make the management aware that whatever the funds that we have raised, all those funds are having what kind of cost, so that we can earn from the business minimum at that rate in order to give return to the finance providers. So the objective over here is to know what is the minimum rate at which we have to earn from the business so that we can give return to the finance providers. And with that intention, we are going to have the learning over here of the chapter called cost of capital. Over here, what happens, dear students, we make the computation of individual source of finance cost. Cost of the debenture, cost of preference share, cost of equity shares, cost of retained earning, Like that, say we make the computation of the cost of the individual source of finance. Then definitely we understand that say whatever the business that say we are doing, in that business, say we cannot have a segregation that say the fixed asset is financed with what source of finance, investment is financed with what source of the funds, and whatever the earning that we have is from the business is in total earning. Again, you cannot split the same that say what amount of the earning is from the fixed asset, what amount of the earning is from the working capital. So after making computation of the cost of the individual source of finance, we make the computation of the weighted average cost of capital, or it is also given a name as the overall cost of capital. What is the single rate? What is the single rate at which the company should earn from the business, so that the company will be able to give return to all finance providers as per their requirement. And for that, say we learn the concept called cost of capital, and based on that, say the weighted average cost of capital. Dear students, over here the concept is very simple. The concept is that say the cost of capital is calculated basically for a company. So what is the amount received by the company on issue of the security, and what is the cost, that is what are the payments say, which are made say for using that funds in the business. With that concept we make the computation of the cost of capital. Now as far as the amount received is concerned, say it will be calculated taking into account the issue price of the security. When I say that say we are going to consider the issue price of the security, it means that say we will take into account the premium at which the security is issued, or discount at which the security is issued. Any premium or discount will be taken into account for the purpose of calculating that say what is the issue price of the security, minus say any flotation cost that we are required to incur. Dear students, the term flotation cost stands for whatever the cost that we incur for the purpose of floating the security. We understand logically it is the payment to the merchant banker who will look after the issue proceeding, payment of the underwriting commission. Like that, say any of such payments are there, so that is required to be considered as a part of the flotation cost, and that is the cost which we incur at the issue of the security. So it will be deducted say in calculation of the net amount received by the company for the purpose of using the funds. In comparison to that, say what is the cost that we will consider. As far as the cost is concerned, in simple language, it is the payment of the financial charges. However, dear students, when we make the payment of interest, the amount of interest is debited to the P&L account, and just now as we have discussed, we get the advantage of the tax savings due to payment of interest, and that is considered to be the interest tax savings or interest tax shelter. As far as the interest tax saving is concerned, it is calculated as interest into tax rate. That is deducted from the interest in order to make the computation of the cost. So, interest into 1 minus T, that is the way the cost of debt financing is calculated. This is what we understand is the way we make the computation of the cost of debt financing. Always remember that when it comes to the debentures or it comes to the preferences, you have to see that whether the security is issued for a certain time period or the security is issued for perpetuity. If it is issued for perpetuity, dear students, then in that case cost of debt financing is very simple to compute. It is interest into 1 minus T divided by the amount received by the company. That is the issue price minus flotation cost. That is the simple way by which we make the computation of the cost of debenture. If it is issued for a certain time period, then in that case, say there are two methods by which we can do the answer. Dear students, the first method is say given a name as the IRR method, or it is also given a name as the realized yield method. That is the way we are required to make the computation of answer. In case of IRR method or the realized yield method, what happens at say from company point of view, we prepare a cash flow series, and we make the computation of the IRR of that cash flow series, and that is considered to be the cost of debt financing. So in case of IRR method, say we prepare a cash flow series like this. In the year 0, as a company you receive the sale value of the security, that is the issue price minus flotation cost. Then you make payment of the interest, that is outflow. On making payment of interest, you get the tax saving, so it is inflow. Year 0, you may have to incur the flotation cost. And last year, you will have the redemption value of the security. Whatever this kind of cash flows that you have, for that, so the net cash flow will be prepared, and using trial and error method that you have in your capital budgeting, with that, so you make the computation of the cost of debt financing. So if at all the security is issued for a certain time period, and we have been provided that, so you are required to adopt the realized yield method for calculation of the cost of debt financing, then this is the way we are required to calculate KD. And in case of formula method, what will happen? It is interest into 1 minus 3. That is the payment of interest is converted to post-tax. Plus redemption value minus amount received divided by the number of years for which the security has been issued, divided by redemption value plus amount received divided by 2, and then whole into 100 for the purpose of KD, that is calculation of the cost of debt financing. This is an approximate formula. The reason it is given a name as approximate formula, because you can see that say absolutely there is violation of the concept of time value of money. This is the way the KD will be calculated. Whatever I have explained for the KD, the same itself is applicable for cost of preferential, with the only exception that say you will not get advantage of the interest tax saving as what you get in case of payment of interest. So over here it is the preference dividend plus redemption value minus amount received divided by n, whole divided by redemption value plus amount received into 1 by 2 into 100 for getting answer in percentage term. In case of IRR method, year 0 you receive the sale value of the security, then you make the payment of the preference dividend. In the year 0 you are required to incur the flotation cost. Last year you will have the redemption value to be paid as outflow. You make the computation of the net cash flow, and for this you make the computation of the IRR. And this IRR is considered to be the cost of preferential. This is the way the KP will be calculated. Now let us have a discussion of cost of equity. For cost of equity calculation, there are 4 approaches that they have provided. One is given a name as dividend discount model approach. Next is CAPM, capital asset pricing model approach. Then earning approach. And the last is realized yield approach. That is called internal rate of return approach. So these are the 4 approaches that we have. Whenever information is provided to us in terms of the beta of the security, we'll apply the CAPM for calculation of the cost of equity, in which the formula will be applied as risk-free rate of return plus beta into return on the market portfolio minus risk-free rate of return. I'm not going in the detailed explanation of the formula, being the revision session. Sometimes we are provided with the difference of the return on the market portfolio and risk-free rate of return, that is called market risk premium. So be careful to read language of the question properly, whether you have been provided with the risk premium or whether you have been provided with the return on the market portfolio. As far as the realized yield or IRR method is concerned, in that, importantly, from an investor point of view, we will prepare a cash flow series, because whatever the rate at which the investor is getting the return becomes cost to the company. In that sense, we will consider, let us say that the time period of holding security is 3 years. So for 3 years, you will receive the dividend income. At the end of the third year, you'll get P3, price of the security at the end of third year. In the year 0, you must have purchased the security at P0. For this, net cash flow series will be prepared, in which year 0 cash outflow, year 1 to year 3 cash inflow. Whatever this cash flow series that say you compute, for that we will make the calculation of the internal rate of return, and that is considered to be the cost of equity. That is the way the KE will be calculated. Next is the earning approach. Dear students, for the earning approach, no numericals are provided to us in the example. That is, say in the module, still we understand it as earning per share upon market price per share. That is the way the cost of equity is calculated, and if at all the growth rate information is given, then in that case the growth rate will be added to it. Otherwise, that is, if at all such kind of information, let's say you are required to apply the realized yield method or beta, such kind of information is not given, then always the dividend discount model approach will be applied for the purpose of cost of equity calculation. So for cost of equity calculation, we will have the working like this: D1 divided by P0 minus flotation cost plus growth rate. This is the formula which you are required to apply. This is the same formula that you study in your dividend policy called Gordon model. As far as the G growth rate is concerned, it is calculated as B into R. B stands for retention ratio, R stands for the rate of earning. The term P0 stands for the current market price of the security. F stands for the flotation cost, and D1 stands for dividend per share at the end of the next year. Sometimes, dear students, we are provided with the D0. So what happens is you are required to convert that D0 into D1 term as D0 into 1 plus C. That is the way so the D1 is calculated. That is so the expected or the projected dividend at the end of the first year. Now we may be provided that to compute the cost of the existing equity shares. In that case, say this flotation cost will not be considered by us to be deducted in calculation of the cost of equity. In that case, the cost of equity will be calculated as D1 divided by P0 plus growth rate. Sometimes directly or indirectly, the question is providing the information that says there is no growth in the dividend. That is the information is given that the growth rate is 0. If at all the growth rate information is not given, then in that case this becomes the cost of equity formula. In that case this becomes the cost of equity formula. Accordingly, we are required to make the computation of the cost of capital. So you just have to see, let's say, whether the growth rate information is provided to us or not for the purpose of calculation of the cost of equity. Next, we may be provided with the calculation, that is with the information to compute the cost of retained earning. As far as the cost of retained earning is concerned, for that we understand the logic is that the retained earning is considered to be the indirect investment made by the equity shareholders. So if at all shareholders personal tax rate information is not given, if at all shareholders personal tax rate information is not given, brokerage information is not given, and flotation cost information have not been given. If at all these three information have not been given, then in that case the cost of retained earning is same as the cost of equity with no change. If at all the flotation cost information have been given, then in that case it will be considered in cost of equity calculation and not for cost of retained earning, because the company does not have to incur any cost for raising the financing in form of retained earning. Next, listen to me carefully. If at all we have been provided with the information about the shareholders' personal tax rate and or the brokerage information is given, then cost of retained earning is equal to cost of equity into 1 minus personal tax rate of the shareholder into 1 minus brokerage. That is the way we are required to make the calculation of the cost of retained earning. Now all this, like the discussion that we have made, is with respect to the cost of the individual source of finance. Now it comes to the weighted average cost of capital or overall cost of capital. In that, we understand the concept is divided into two parts. One is the book value approach and another is the market value approach. That is the way it is divided into two parts. Before I proceed further, I would like to address to one of the point, that is flotation cost. Dear students, with respect to the flotation cost, the institute suggested answer is not having a consistency. If at all it has been specifically given that the flotation cost is required to be computed based on the issue price of the security, then of course, taking into account the issue price of the security, flotation cost would be calculated. But if at all such kind of clarification is not made, then in that case, sometimes the flotation cost is on the issue price and sometimes it is on the face value. My suggestion to all of you is that generally I have seen that it is calculated on the face value of the security. So accordingly, you may compute the answer and put a note for the same. This is what's a suggestion which I have. Of course, you put a note whenever there is no clarification in the question that on which value the flotation cost is required to be computed. Now, book value or the market value, like that, say there are two concepts that say we have. As far as the book value is concerned, in that say the book value of the security will be taken into account as a base for computation of the weighted average cost of capital. That is cost of equity into weight of equity plus cost of retained earning into weight of retained earning, cost of debenture, weight of debenture, cost of preference share, weight of preference share, and so on. Cost of term loan, weight of term loan, and so on. That is the way, so you are required to adopt the book value approach for weighted average cost of capital. In case of market value approach, say as far as the weights are concerned, weights are going to change. It will be taken based on the market value of the security instead of book value of the security. Remember importantly that the cost of the individual source of finance is not going to change. That is an important point. As far as the market value approach is concerned, in that we will take the market value of the security for calculation of the cost of capital, and if at all no information is provided to us with respect to the market value of the security, book value itself will be taken as market value and put a note for the same. Importantly, as far as the equity shares are concerned, the market value of the equity share is deemed to include the effect of the retained earning also. So the market value of the equity will be divided into book value of equity and book value of retained earning for the purpose of calculation of the weighted average cost of capital. This is what we understand. Institute is not doing this consistently every time. However, I strongly suggest that you are required to take into account the bifurcation of the market value of the equity into book value of equity and book value of retained earning. One very important point that I want to tell you is this. Suppose we have been provided with information about the book value of debenture 5 lakhs and market value of debenture as 6 lakhs. Rate of interest is 10% and income tax rate is 40%. Suppose say no redemption information is given. Then do remember, most importantly, cost of debenture will be calculated as 5 lakh rupees of the debentures into rate of interest 10% into 1 minus 0.40 divided by market value of the debenture, that is 6 lakhs. That is the way the cost of debenture will be calculated. What I want to tell you importantly is that say whenever you are computing the cost of capital for any security, then in that case always we assume that say whatever the existing price of the security is the price at which the security will be issued, unless we have been provided with any other issue price. With respect to the amount received, remember that say we may be provided with only face value, then the face value will be taken as the issue price. Then we have been given the face value and market price of the security, both information have been given. then in that case, so assuming the current security will be issued at the current market price, will calculate the cost of capital. We have been given the face value, market price, and issue price of the security information is given. We'll assume the security will be issued at the issue price. Because practically what happens at say number of times at the current market price, you may not be able to issue the security. This is the price which is going on in the secondary market. So you have to issue the security at slightly lower value. That is considered to be say the price at which the security will be issued. So this is what we understand. Next, importantly remember that say whenever we are required to compute the weighted average cost of capital, then in that case, if at all regarding book value approach or market value approach, clarification if at all not given, you can do answer by either of the method and you put a note. If at all nothing is specified, my suggestion is to go with the book value approach because most of the suggested answers are like that. That is a suggestion which I have. Next, importantly remember that say for weighted average cost of capital calculation, we may be provided with one kind of question in which plain information is given with which the weighted average cost of capital is required to be found. Second, we will be provided with the question which is divided into two phases. Using the existing information you are required to find, then the company is raising the additional financing. And after raising the additional financing, overall cost of capital is required to be calculated. That is the second type of the question. Third is existing weighted average cost of capital is required to be found, and we are provided with the additional financing information, and we are required to find this weighted average cost of capital and this weighted average cost of capital. Like that, say only for the marginal, incremental, additional weighted average cost of capital is to be calculated. Fourth, we will be provided with the information that say what is the capital structure proportion that we have. Debt is 30%, equity is 70%. We are provided with the information that say we require an amount of rupees 50 lakhs. So over here 30% is debt, that is 15 lakhs, and 70% is equity, 35 lakhs. Then we will be provided with the information that we have the retained earning to the extent of 20 lakhs. In that case, the new issue is going to be 15 lakhs. Taking into account, so this 15 lakhs, 20 lakhs and 15 lakhs, we are required to compute the weighted average cost of capital. Remember that so this retained earning of the 20 lakhs is considered to be the part of the equity financing. You don't have to consider that say we require 50 lakhs, we already have 20 lakhs. Now for the remaining 30 lakhs, let us do the bifurcation. No. The overall 50 lakh rupees of the financing, for that the bifurcation will be made. The next is the type of question which will be provided to us is this. We are provided with the existing capital structure proportion. That is equity, debentures and preferences. Suppose it is 50%, it is 30% and it is 20%. We are provided with the expected retained earning. Let us say that it is an amount of rupees 5 lakhs. And the question is asking about that say the computation of the weighted average cost of capital if at all the retained earning will be used say as a source of the finance. Then we are provided with the question that what is the capital investment beyond which the new issue is required to be made. In that case, friends, it is the amount of the retained earning upon weight of equity. That is the way we make the computation of the financing. That say beyond 10 lakh rupees will require the new financing. That is the way the information is required. That is the answer is required to be calculated. One more thing that I would like to clarify, that in case of existing security, suppose it has been provided to us that the debentures were issued before 3 years for 8 years, and so on information have been given. That's the face value is 1000. It was issued at 900. Right now the price is 950, and so on information have been given. In this case, say suppose we are using the approximate formula for doing answer. Then interest into 1 minus t plus redemption value minus amount received divided by n whole divided by redemption value plus amount received divided by 2. Interest will be calculated always on the face value of the security, whatever may be the current price. Into 1 minus T is okay. Redemption value, whatever we have committed at this point of time. Now, as far as the amount received is concerned, that is very important. In case of amount received, we do not have to take into account 900, we have to take into account 950. What is the price at which today you can issue the security is important, and accordingly the amount received will be taken. Number of years will be taken, not 3, not 8, but the number of years will be taken as 5. The logic is that, say, if at all we issue today the security for 5 years, then in that case we can get today 950 rupees. That is the reason, say, we will take over here N as 5 years. So these are the things that, say, you should consider in a revision of the chapter of cost of capital. From theory point of view, these are the questions which have been asked in examination. In November 2009, a question was asked about the explanation of the plowback of the profit, that is retained earning. Next was, what do you understand by the weighted average cost of capital? That is a definition that we understand. Discuss the financial break-even and EBIT EPS indifference analysis. Then very simple, distinguish between the preference share and debentures. Then explain the significance of the cost of capital. Like that, so these are the very simple questions which have been asked, say, over here from the segment of the cost of capital. This is what we have. The next is the capital structure theories. In that, say, the concepts that we have, excluding the financial indifference point and the questions with respect to those concepts. It is the net income approach, without tax and with tax, net operating income approach, without tax and with tax, Modi-Gilani-Miller approach, without tax and with tax. 5 marks question was asked in November 18 examination. Approach with taxes, in that 5 marks for asked for 2 times. Then traditional theory, trade-off theory, picking theory. These theories have not been tested in examination. On an average, it is 3.75 marks that we have, except from this chapter. Friends, as far as the capital structure theory chapter is concerned, in that the logic of this chapter is, we already have decided, we already have come to a conclusion. Let us say that, say, we require an amount of rupees 50 lakh rupees of the funds. Now this amount of the financing that we require, in that, so what should be the proportion of the equity financing and what should be the proportion of the debt financing that we have to decide. That decision making, let's say what portion should be the equity financing and debt financing, to decide that, say, we learn this chapter. We understand that, say, over here, say, we have the expert's opinion, just now as I read, NI, NOI, MM and so on. They guide us that, say, how you should be having, say, the debt and equity financing combination. Ultimately, we have an objective, say, to have such kind of combination so that the weighted average cost of capital is falling down and so that, say, the value of the firm is increasing. With that intention, say, we have to learn, that's the capital structure theory chapter. Before we start with the individual theory, I would like to have a small discussion with you like this. Always remember that, say, one thing, that the cost of equity is always greater than the cost of debt financing. Why? Because the equity financiers are taking risk in the business. They do not have any assurance of getting the income in form of equity dividend. They do not have any security in form of the mortgage assets in the event of the liquidation. They are last in the queue to receive that amount, and say, considering these kind of risk aspect, always the cost of equity is bound to be more than the cost of debt financing. Second point that, say, you should always remember is that, say, whenever there is an increase in the debt financing in the capital structure, then in that case the expectation of the equity shareholder increases. Why expectation of equity shareholder increase? It increases due to the reason that say the risk for the equity shareholder increases. So with more and more debt financing, cost of equity increases. These are the two things that you should always remember. Next, as far as the net income approach, net operating income approach, Modigliani-Miller approach, and traditional theory. These capital structure theories have made certain common assumptions. So any of the theories asked upon, you can always write these common assumptions. The common assumptions are like this. First, let's say there is only equity and debt financing. There are no other sources of finance like preferential capital, like retained earning. Second, the debt financing is always raised for perpetuity. There is no concept of the redeemable security. And equity is always for the perpetuity anytime. Third, the assumption is made that the capital market is perfect. It means that the information is available to all investors in equal proportion. It means that an assumption is made that all investors are rational. They always want to get the maximum return for any given level of risk. Assumption is made that there is no flotation cost, no transaction cost, no corporate dividend tax. So that kind of assumption is made over here. Then the assumption is made that the dividend payout ratio of all the companies are always 1. If at all the dividend payout ratio is 1, it means that the retention ratio will be 0. And if at all the retention ratio is 0, then the growth rate will be 0. Growth rate is calculated as B into R. B stands for the retention ratio, into R stands for the rate of earning. Multiplication of both of them would be 0. Why? Because the retention ratio is 0. These are the common assumptions which have been made, say, by all the capital structure theories. Now, I am starting one by one with the individual capital structure theories. Net income approach. Okay, net income approach. Whether optimal capital structure is existing, that is question number 1 to NI approach. Then the answer is yes, that optimal capital structure is existing. Which capital structure is optimal capital structure? That is the next question. Net income approach says that the capital structure which is having the maximum debt financing is the optimal capital structure. Okay. Is there any additional assumption? Yes. The additional assumption which has been made by the net income approach is that cost of equity will remain same irrespective of the proportion of the debt financing in the capital structure. So the company will be able to get the advantage of the lower cost of the funds in the capital structure, and with that the weighted average cost of capital is falling down. That is the kind of the explanation that the NI approach has given. Just now whatever I have said like this, that with the increase in the debt financing, cost of equity increases, that is eliminated by the assumption of the NI approach. So the NI approach says that you should raise the debt financing so far possible. With that you will be able to reduce the weighted average cost of capital and increase the value of the firm. There is a concept over here which they have introduced, so that is considered to be the value of the firm. Dear students, value of the firm is calculated like this. It is earning before interest and taxes minus interest, that is earning before taxes minus income tax is earning after taxes. There is no preference dividend, so earning after taxes itself is the earning available to equity shareholders. Amount of the equity dividend is 100%. So whatever is the earning after taxes itself is the equity dividend. So the same is divided with the cost of equity to compute the value of the equity. So value of the equity is calculated as earning after taxes upon cost of equity. Value of debt is added to the value of equity, so to compute the value of the firm. Over here, say the NI approach has a conclusion that the capital structure which is having the maximum debt financing will have the lowest weighted average cost of capital and will have the highest value of the firm. That is the way the optimal capital structure is existing according to them. This is NI approach. Dear students, the conclusion of the NI approach without taxes and with taxes is going to remain same. When you make the computation of the valuation of the firm, then just be careful that so the cost of equity is supposed to be taken same for both of them. That is whether it is a levered firm or it is an unlevered firm. Further importantly, as so the 100% of the earning is paid in form of equity dividend, so the weighted average cost of capital is calculated as earning before interest and taxes into 1 minus T. So it is called net operating profit after taxes. That is earning before interest and taxes into 1 minus T upon value of the firm. That is the way the weighted average cost of capital is calculated. Okay. Then it comes to the net operating income approach. Dear students, in case of net operating income approach without tax and with tax, the conclusions are different. So be careful. I am talking first of all, I am having a discussion first of all without tax. And then I will do the discussion with taxes. In case of without taxes, optimal capital structure is existing. The answer is no. There is nothing like optimal capital structure. Which is optimal capital structure? Answer is not applicable. Why? Because there is nothing like optimal capital structure. Assumption, there is no assumption. However, over here there is an additional point that say they have provided in terms of the conclusion. The additional point that say they have provided like this. Listen to me carefully. That whenever there is an introduction of the debt financing in the capital structure, at that time, expectation of the equity shareholder increases. That is, cost of equity increases. It increases in such a way so that the benefit of raising the debt financing is compensated with marginal increase in the cost of equity. Hence, value of the firm and weighted average cost of capital will remain same. That is the way the conclusion is drawn. Whenever there is an increase in the debt financing, at that time expectation of the equity shareholder increases, and it increases in such a way so that the benefit of raising the lower cost of the funds is compensated with marginal increase in the cost of equity. That is what we have. Dear students, over here in case of net income approach, so the diagram is like this. This is the cost of equity, this is cost of debenture, and this is weighted average cost of capital. This is in case of net income approach. On x-axis we take the debt financing in capital structure. Debt finance in capital structure. And on y-axis we take the cost of capital. This is what we have. With the introduction of the debt financing, the company is getting advantage of the lower cost of the funds. So the weighted average cost of capital is falling down. This is what we understand. Okay, next. In case of NOI approach without taxes, the conclusion is made like this. Again, on x-axis the proportion of the net financing in capital structure. On y-axis it is the cost of capital. This is cost of debt financing. When there is no debt financing at that time, cost of equity and weighted average cost of capital are same. Whenever the debt financing increases, at that time the expectation of the equity shareholder increases. So this is what we understand is the cost of equity. That with the increase in the debt financing, cost of equity increases. It increases in such a way so that the benefit of raising the lower cost of the funds is compensated and the weighted average cost of capital is same as it was otherwise. This is the conclusion that it has drawn. Okay. Now, as far as the NOI approach without taxes is concerned, whenever you are doing its answer, always remember that, say, whatever the answer that you compute like this for the value of the unlevered firm, in that the value of the firm for unlevered and levered will be same. Unlevered and levered will be same, because the conclusion is that say the always value of the firm and weighted average cost of capital will remain same. Afterwards, you are required to do backward working for the purpose of calculation of the cost of equity. Okay. Now, with taxes, whether optimal capital structure is existing, then this time the answer is yes, it is existing. Which is the optimal capital structure? The conclusion is same. A capital structure which is having the maximum debt financing. Okay. Whether the cost of equity remains same with the introduction of debt financing? No. With the increase in the debt financing, expectation of the equity shareholder increases. However, this is going to remain same. However, the company is getting advantage of the interest tax savings. And because of the interest tax saving advantage, value of the levered firm is more than the value of unlevered firm. So, in case of net operating income approach with taxes, value of the levered firm is calculated as value of unlevered firm plus present value of the interest tax saving. It is calculated as value of debt into income tax rate. That is the way the value of the levered firm is calculated. This is what we understand. Okay. So over here, we are required to make the computation of the value of the unlevered firm first of all every time, and then we'll apply that formula to compute the value of the levered firm. Over here, the logic is that with the introduction of the debt financing, the company is getting advantage of the interest tax saving, and because of that, the value of the levered firm increases, and its weighted average cost of capital is falling down. This is what we understand. Again, on x-axis, the debt financing in the capital structure. On y-axis, it is the cost of capital. This is the cost of debt financing. See, the cost of equity goes like this. No doubt about it. However, at the same time, the company is getting advantage of the interest tax saving. So, the weighted average cost of capital is falling down like this. Okay. The next comes to approach, that is Modi-Gilani-Miller approach. Dear students, whenever it comes to the approach, then in that case, there are two things that you should always remember. One is the calculation portion with respect to value of the firm, with respect to the weighted average cost of capital and so on. And another is the arbitrage process. Like that, we have the bifurcation like this. As far as the value of the firm and weighted average cost of capital is concerned, its calculation is exactly the same as NY approach with no changes. It is exactly the same as NY approach with no changes. When it is the arbitrage process, then in that case the calculations are different. Let us understand that in case of arbitrage process, what happens. Students are requested to remember, that is, understand the arbitrage process explanation in this way. Always remember that in case of approach is followed, there is a situation of no income tax. Information is provided about the two firms operating in same risk class, having same operating income, and they have different value. In that case, a situation of arbitrage exists. What are the conditions? Okay. No tax? Okay. The companies are operating in same risk class, homogeneous risk class, uniform risk class. They have the same operating income and they have a different value. Always, an investor of overvalued firm will be able to get arbitrage with switch over to undervalued firm. So what happens at say investor of overvalued firm will switch over to the undervalued firm. Now dear students, this overvalued firm may be levered, may be unlevered. And this undervalued firm will be the opposite one. If overvalued firm is levered, then undervalued will be unlevered and vice versa. So always an investor of overvalued firm will switch over to the undervalued firm for the purpose of arbitrage. The overvalued firm may be levered, may be unlevered. That is what we understand. I just give you a small explanation further to you like this. Suppose like levered firm and unlevered firm. Levered firm has a value of rupees 3 lakhs and unlevered firm has a value of rupees 2,50,000. So this 3 lakh that is rupees will be consisting of, let us say 2 lakh rupees of the equity and 1 lakh rupees of the debt. Now an investor of the overvalued firm is switching over to the undervalued firm. So what happens at say in this example, it is levered to unlevered. Then in that case, remember that the investor is going to borrow in between. So whenever there is switch over from the levered to unlevered, then in that case there is borrowing in between. Why there is borrowing? Because in order to keep the debt exposure same, so there will be borrowing of the funds. Further, if at all there is a situation in which an investor is switching over from unlevered to levered, then in that case the investment has to be made in debentures plus equity shares both. These are the things that you should always consider. Whatever the percentage of the equity investor that you assume say before switch over, like suppose say an investor is switching over from levered to unlevered and he was holding 10% equity shares of the levered firm. Then after switch over he will be holding same 10% equity shares of unlevered firm, and with that he will be able to maintain his income and he will have some amount of the surplus. This is the way we are required to do the arbitrage process. In my opinion, there are simple 4 steps that you are required to follow. Step number 1 is the current position of overvalued firm's investor. Current position is divided into 3 parts. A. What is the current income? B. What is the amount of investment? And C. What is the debt exposure? If at all investment is made in the levered firm, only in that case there will be debt exposure. If it is unlevered, then in that case the debt exposure will be 0. Second, the investor of overvalued firm will be told that you sell investment. On sale of investment, you will realize some amount of the funds. Third, importantly, you are required to borrow if at all you switch over from levered to unlevered. If at all you do not switch over from levered to unlevered, then in that case step number 3 will not be applicable. Step number 4, in that you make investment. If at all you are making switch over from levered to unlevered, then invest only in the equity and you will make investment in the same percentage of the equity as you were holding earlier. If it is unlevered to levered, then you will make investment in equity and debentures both. Why? Because earlier your debt exposure must be 0. You made investment in unlevered form. However, the new investment is in the levered. That is the reason you will have investment in both, in equity as well as debentures, and you will be having the debt exposure if at all you make investment only in equity. So to nullify that, you invest in debentures also. That's it. This is the way we are required to do the answer. The next is the traditional theory. As far as the traditional theory is concerned, it has a conclusion that the optimal capital structure is existing. If at all you raise debt financing up to a certain point of time, that is, initially when you raise the debt financing, the advantage that you have is more in comparison to the increase in the cost of equity. If at all you raise debt financing further, then whatever the advantage that you have, that itself is the increase in the cost of equity. And after that, so the increase in the cost of equity is at a higher rate in comparison to the advantage that you have of raising the debt financing. That is the way we have the three stages in which so the debt financing raise, that is raising debt financing, will have the impact on the weighted average cost of capital and value of the firm. Next, as far as the trade-off theory is concerned, trade-off theory has a similar point that initially say you have more advantage and later on say the expectation increases. There are certain, that is, two costs which increases with the increase in the debt financing. One is the present value of the financial distress and another is the agency cost. Present value of the financial distress means that say you are required to keep higher current ratio because raising of the debt financing. You are required to keep higher interest coverage ratio because of the raising debt financing. You are required to say obtain permission of the financial institution before say you make investment in any project which requires the huge investment of the funds. All these are considered to be the financial distress when you raise the debt financing. So again, you should raise debt financing to a certain point of time, not beyond that. The last is the pecking order theory. As far as the pecking order theory is concerned, this theory says that you should raise the financing by way of retained earning, by way of debt financing. That's it. These are the two the sources by which you should raise the financing every time. As far as the new issue is concerned, new issue is considered to be a bad news in the market and the company should not raise the additional financing by way of the new issue. These are the conclusions that we have with respect to the capital structure theory. Now the theory questions. Question number 8 is the theory question. In that, the first question is, what do you understand by capital structure? How does it differ from the financial structure? Dear students, the financial structure is the entire left-hand side of the balance sheet. That is equity share capital, reserves and surplus, security premium, preference share capital, debentures, long-term loan, short-term loan, current liabilities, provisions, everything is what we understand is a financial structure. And from this, the entire left-hand side of the balance sheet, if at all we focus only on the long-term financing, equity share capital, reserves and surplus, security premium, preference share capital, debentures, term loan and everything, then in that case it is the capital structure. Okay. What is NOI theory of the capital structure? Explain the assumptions. So NOI and its assumption, very simple. List the fundamental principles governing the capital structure. Dear students, so the fundamental principles governing the capital structure includes risk, cost and control. We understand that from the company point of view, if at all you go for the equity financing, risk is less because you don't have a commitment for making payment of financial charges for the purpose of redemption. You go for the debt financing, risk is high because whether you make a profit or you incur a loss, you have to make payment of the financial charges. Further, whether you make a profit or loss, do you have the cash or not, there is a specific point at which you are supposed to redeem the security. If at all you do not have the sufficient funds, even in that case you have to raise the funds by any means, otherwise the company will be liquidated. Cost. As far as the equity financing is concerned, its cost is more because expectation of the equity shareholders are more. And for debt financing, the cost is less, considering that the company will be able to negotiate for the lower rate because the fixed commitment is given. And the second thing that we understand is that the Payment of the interest is allowable expense from tax point of view, so you get interest tax saving. Control, there is a dilution of the control when you go for the additional debt financing and promoters are not purchasing the same percentage of the equity shares that say they were having earlier. In case of debentures, so there is no dilution of the control. Financing of the business through borrowing is cheaper than using equity. The first is the risk aspect, second is the flotation cost. In case of the equity financing, the flotation cost is bound to be higher, because when you have to convince somebody, say, to take a risk, then in that case, so the cost is going to be higher to save that kind of security. Third thing is that's the tax saving that you have on making payment of interest, which you do not get in case of equity dividend. What do you understand by the capital structure? State its significance in the financing decisions. So the capital structure is all long-term sources of finance. State the principles that should be followed while designing the capital structure of the company. So it is similar to covered in November 30. Explain the relationship between the cost of capital, capital structure, value of the firm according to NI approach and according to NOI approach. So in both the cases, so what kind of conclusion is there? So you have to write everything. You have to write the assumptions, you are required to write the conclusion. In case of NI approach, it is same whether tax is there or not. In case of NOI, the assumptions are different. You may write additional in the formula to give answer of the question. This is the way, so we have like the NOI approach and NI approach with respect to the capital structure theory question. Starting with the next chapter. The next chapter is leverage. Let us see from examination point of view its significance. The concepts that we have is degree of operating leverage, degree of financial leverage without preference dividend, degree of financial leverage with preference dividend information, then combination of DOL and DFL. 10 marks question was there. DOL with beta, that is a unique question that we have. Then degree of combined leverage without preference dividend and with preference dividend. 5 marks question was there again, say from the degree of combined leverage. Then combination of all the leverages. 10 marks question. Combination that we have again of all leverages. 10 marks question that we have. On an average, it is 35 marks in the last 4 attempts. So it is 8.75 marks is what the average marks to the leverage chapter. A very simple chapter from examination point of view and an excellent chapter from the practical point of view. Especially friends in like the situations like Corona, everybody must have understood. All businesses must have understood the significance of the fixed cost. Leverage is basically a chapter in which we try to understand, say, the effect of the fixed cost. Fixed cost is what you are required to bear, irrespective of the revenue that you have. We understand that the fixed cost is indicating that this amount of the cost that you are going to incur is going to remain fixed. Whatever may be the activity level that you have, that is considered to be the fixed cost. Now, in this chapter, we learn basically 3 leverages. One is degree of operating leverage, another is degree of financial leverage, and the last is degree of combined leverage. As far as the degree of operating leverage is concerned, it is measuring the effect of operating fixed cost. Degree of financial leverage is measuring the effect of the financial fixed cost. And degree of combined leverage is measuring the effect of both the fixed cost. That is the way, so there are 3 types of fixed cost that we have. So let us talk about first of all the operating fixed cost. The operating fixed cost means the cost that you are going to incur in terms of doing operation of the business. That is the operating fixed cost that we have. Degree of operating leverage. It is calculated using the basic formula as contribution upon operating income. And degree of operating leverage is measuring that what is the percentage change in EBIT for every 1% change in the revenue. With the increase in the sales, operating income is going to increase. What is the rate at which it is going to increase is measured by degree of operating leverage. We understand that, say, suppose DOL is 3. It means that, say, if at all the sales increases by 10%, operating income will increase by 30%. That is what the degree of operating leverage is indicating. If at all I am talking about the increase, the same is applicable for the reduction. Let's say the sales value is decreasing by 10%, then in that case, so the operating income reduces by 30%. That is what we understand. Now, always say there is one fundamental point that you should understand is this. Let's say whenever we have been asked that you have to pass comment, then in that case you have to understand like this. Suppose information is given about a company called ABC and industry information is given. The industry degree of operating leverage is 5. Okay. For ABC it is 6. It is okay, no problem, very near to the industry. If it is 4, again it is okay, very near to the industry. So any leverage which is near to the industry is considered to be the appropriate leverage. If at all it is substantially more, then in that case we will advise the company to reduce the leverage immediately. Why? Because higher leverage is indicating higher risk. When sales increases, you are happy that your operating income will increase at a higher rate. However, at the same time, when the revenue decreases, then in that case your sales reduces, then in that case your profit will decrease sharply if at all you have more leverage. Second thing that we understand is like this. Suppose the industry leverage is 5 and ABC has leverage 2. Then in that case we can say that there is a scope of increasing leverage. We cannot insist a company to increase the leverage. Why? Because introduction of the leverage is depending upon the confidence level that you have for the purpose of maintaining the future business. If you are confident, then in that case you will keep the leverage more. If you are not confident, then in that case you will keep your leverage less. This is what we understand. Now, suppose information is provided to us about two companies, ABC and XYZ. And we have been passed, that is asked that you pass comment. Industry data is not given. Then in that case, how you should pass the comment, I explain that to you. Suppose for ABC it is 2 and for XYZ it is, let us say 6. Then we can say that, listen carefully, as far as the XYZ is concerned, its leverage is high. So XYZ will have more advantage when the sales increases. At the same time, XYZ will have the reduction in the profit rapidly when the sales increases. So it is the high risk, high return game. In case of ABC, the leverage is less. So when the sales will increase, then the profit will increase at a lower rate. Of course, it will increase. It is not going to decrease. But the pace at which it will increase is less. And when sales is declining, then the profit will reduce at a lower rate. That is what the ABC limited leverage is indicating. This is the way you are required to pass the comment. And whatever I have said for DOL, the same copy paste is applicable for DFL and the same copy paste is applicable for DCL. From the comment point of view, you have these two things always to consider. As far as the degree of financial leverage is concerned, for degree of financial leverage calculation, we understand that you are required to see that whether the preference dividend information is given or not. Suppose preference dividend information is not given. Then in that case, the degree of financial leverage will be calculated as operating income divided by earning before taxes. Like that it is calculated. And if at all the preference dividend information is given, then in that case, say the degree of financial leverage is found as operating income upon earning before taxes minus preference dividend divided by 1 minus t. That is the way we are required to make the computation of the degree of financial leverage. In this situation, degree of financial leverage is measuring, let's say, what is the percentage change in earning before taxes and earning per share for every 1% change in EBIT. Over there, say it is measuring, that is, if at all the preference dividend information is given, that what is the percentage change in EPS for every 1% change in EBIT. That is the way we are required to say measure the percentage change in EBIT relationship. This is what's the degree of financial leverage. Dear students, we understand that say in capital structure, okay, on the liability side of the balance sheet, it is the equity, reserves, security premium is like the equity portion. Preference capital, debentures, loan is the debt proportion. We understand that say what should be the proportion of the equity and debt. That is what we understand is like one decision which is going to influence the degree of financial leverage. Again, logically we understand that say if at all your operating income increases, then in that case the payment of the interest does not increase. Payment of the preference dividend does not increase. So you will be able to increase your earning per share at a very high rate. So you are very happy with that. At the same time, the story does not end over there. When your sales is decreasing, your operating income is falling down, then in that case your earning per share is going to fall down rapidly. Why? Because the payment of the fixed financial charges is going to remain same. This is what we understand. As far as the degree of combined leverage is concerned, always it is calculated as the product of these two, DON into DFL. By using this simple formula, it is calculated. Degree of combined leverage is measuring, if at all there is no preference dividend, it is measuring, let's say, what is the percentage change in earning before taxes and earning per share for every 1% change in sales. And if at all the preference dividend information have been given to us, then in that case the degree of financial leverage measures what is the percentage change in EPS for every 1% change in sales. That is what we understand is the degree of financial leverage is. So degree of combined leverage is indicative. That is measuring the effect of the overall leverage. This is what we understand. Next thing is that we may be provided with the beta information, which you study in your CAPM in your cost of capital chapter. We understand that the beta is indicating the risk. So with the increase in the beta, the leverage is also going to increase. Accordingly, we are supposed to say understand the effect of the beta along with the leverage. So here I want to give reference of a question wherein we are provided with the four companies information have been given. So here is a question wherein information is provided about the four companies. Change in the revenue is given in percentage term. Change in the operating income is given in percentage term. And the beta information is given. The question says that you are required to compute the degree of operating leverage. For calculation of the degree of operating leverage, contribution upon EBIT, this formula cannot be applied because the sufficient information is not given. So we'll apply the formula like this, that percentage change in EBIT upon percentage change in sales. This is the formula which we are required to apply. That is the first thing. Second thing that I want to tell you is this, let's say you can see that the beta value increases. The question says that say use operating leverage to explain why these firms have different beta. Dear students, we observe that say with the increase in the beta, leverage also increases. So the only thing that say we have to mention over here that both of them are measurement of the risk. So with the increase in the risk, beta as well as the leverage increase. One more explanation I want to give. Let us say that information is provided a company say about the balance sheet. Income statement is provided to us. The question says that say you are required to compute the operating leverage, financial leverage and combined leverage. Okay, that is very simple because the entire income statement is provided to us, so it is simple for us to compute. If the total assets remain same at the same level, but the sales increases by 20%, sales reduces by 20%, what will be the EPS at the new sales level? Now dear students, for the purpose of B question, what you can do, you can apply the formula for DCN, which measures the percentage change in EPS with respect to percentage change in sales. This is the way you can apply the formula and you can compute the answer, or otherwise say you can prepare a table with the new sales value and you can compute the answer. Either of the way the calculation of the answer is acceptable in examination. That is the way say you can make the calculation of answer. There is one more special kind of question to which I want to draw your attention. Information is provided to us, let us say about equity share capital of a company, debentures of the company information have been given. Sales is given 84 lakhs, fixed cost is given 6,96,000, degree of financial leverage is given 1.49, profit volume ratio 27.55%, and income tax rate information is given. The question says that say you compute the degree of operating leverage. Then of course the sales information is given. It is an amount of 84 lakhs. I am just making some rough calculation to explain you. We can see that the profit volume ratio is given to us 27.55%. So 84 lakhs into 27.55%, it comes to 23,14,200. 23,14,200. Amount of the fixed cost is given excluding interest, then of course it is the operational fixed cost 6,96,000. So we can make the computation of the EBIT. So minus 6,96,000. So earning before interest and taxes 16,18,200. That's okay. So contribution is 23,14,200 divided by 16,182,00. So that comes to 1.43. The next question is compute the degree of combined leverage. You can see that the degree of financial leverage is given 1.49. So 1.49 into 1.43, that comes to 2.13. That is also very simple to find. The last question is compute the EPS. Now EBIT minus interest. Now we can see that say information is given 12% bonds of rupees 1,000, 37 lakhs. So it is 37 lakhs into 12%. So the amount of interest is 4,44,000. It is subtracted from EBIT 16,18,200. So it is 11,74,200. That is the way the earning before taxes and so on calculation can be made. Now listen carefully what I am going to speak. When we make the DFL calculation as EBIT upon EBT, okay, when we make calculation like this, then earning before taxes is EBIT upon DFL. Okay, listen to me carefully. Amount of EBIT is 16,18,200 divided by 1.49. So 16,18,200 divided by 1.49. So it comes to 10,86,040.27. Now this EBT that you have computed is 11 lakh, taking into account the debenture interest which is given, and using this DFL value, if at all you make the computation, then the answer is 10 lakh. Now what to do? This is the kind of genuine issue that a student is having in examination. Then the institute has followed the suggested answer in which they have considered this. Why? The reason for that is they have made an assumption that there must be some other amount of the interest. That is the reason the EBT value is 10,86,000. In short, whatever the values which are provided to us in the example, using them will make the computation of the answer, and we always have to make internally check that say the values are internally matching or not. This is a question which has been asked in examination also, and this kind of practical issue that say you may be facing in examination, and you need to be having a broad understanding that say how you should be doing answer. Now similar to that, one more time the question was asked in examination, in which you can see that the degree of operating leverage is 2. Degree of combined leverage is 2.5. So can we compute DFL? Yes. Now fixed cost excluding interest is given. So is it operational fixed cost? Yes. Sales is given, 8% debentures have been given to us. So you can compute the interest amount? Yes. Now you have been provided with the information about the fixed cost of the operation. DOL is equal to contribution upon EBIT. So can we say it is contribution minus fixed cost? Yes. DFL, it is EBIT upon EBT. So can we say it is EBIT minus interest? Yes. Now you have been provided with this information. You have been provided with this information too. DOL is given and DFL is also given. Unfortunately, once again, internally the values are not matching. So in that case, so you have to stick to one value and other will be calculated as balancing figure. Because you do not have the sufficient details, you do not have the information of the details which is say internally matching. This kind of practical issue that you may be facing in examination. Next, sometimes question is asking that say you compute the value of the sales at which like the earning before taxes becomes 0. Now dear students, if at all you go with the table working and if at all you go with the DCL working, then both of them are having say marginal difference in the answer. So sometimes students are having a confusion that sir which answer is correct. You don't worry, both answers are correct. Okay, so just be careful for this point. And when the question is say saying that say the EBT is 0, means percentage change in EBT will be 100% negative in that situation, in that question. Okay. The second point is that the question is sometimes providing us that say you are required to evaluate that say whether the company has whether the financial leverage is working positively for the company or not. Whether the company has taken correct decision of introduction of the financial leverage, that is the question. Now giving answer of this question is very technical. Over here friends, what you are required to do, the first thing that say you have to see that whether the tax information is given or not. Not given, given, tax information. That is what so you are required to see first of all. If at all the tax information is not given, then in that case you are required to make a comparison between return on capital employed with the rate of interest. If at all the return on capital employed is exceeding the rate of interest, then in that case, the company has introduced the debt financing which is working favorable for the company and vice versa. Calculation of the return on capital employed is earning before interest and taxes upon all long-term sources of finance into 100. And if at all the tax information is given, then in that case the return on capital employed on post-tax basis is required to be compared with the KD, cost of debt financing, that is interest into 1 minus T. And if at all this return is exceeding the cost of debt financing, then yes, it works favorably for the company and vice versa. This is the way we are required to understand. Remember that say, when I mention return on capital employed, it means logically, what is the rate at which you are able to earn the return from the business, irrespective of the source from which you have raised the funds. This is indicating the gross rate at which you are able to earn, which is compared with the cost of capital, and based on that say you are taking a decision that say whether raising the debt financing is favorable for the company or not. Now let us see the theory questions from this chapter. What do you understand by the business risk? What do you understand by the business risk and financial risk? That is the question. Business risk is what we understand is that say whatever the risk that you have in terms of the variability on operating income, change in the customer's demand, change in the political environment, all these things which keep on changing, that is a business risk. And the financial risk is measured or it is indicating the introduction of the debt financing in the capital structure. Distinguish between the business risk and the finance risk, and almost you have to write the same answer. Operating risk is associated with the cost structure, whereas the financial risk is associated with the capital structure. Critically examine. Again, it is the same answer. Operating risk is associated with the cost structure. Financial risk is associated with the capital structure. Again, the same answer. So you can see that the single question has been asked for these many times. So from examination point of view, what I want to tell you is that say make sure that say you are doing entire theory. However, at least you have such a good practice of this very question which has been asked for multiple times. You have a writing practice for this also, because this question has been asked for multiple times in examination. Now the most important chapter comes, that is investment decision. That is also called the capital budgeting. Discussing first of all the concept that say we have, the techniques that we have for decision making. The first is net present value. Another is a payback period, discounted payback period, profitability index, desirability factor, benefit cost ratio, NPV index, ARR, average rate of return or accounting rate of return, internal rate of return. Next is a single project evaluation, then mutually exclusive investment, sunk cost, allocation of the common expenses. These two are related to the cash flow calculation. Then the concept of the replacement of the machinery. Then it is capital ration. Next is the concept of the equalized annual cash outflow, equalized annual NPV. Then modified internal rate of return. Then conflict in the ranking of the proposal between IRR and NPV. There is a concept of the pricing of the debenture, pricing of the security. It has the concept of the discounting, so I have included over here. Then cost of equity with the realized yield approach, because we understand in that case the internal rate of return is required to be computed, which is included over here in the capital budgeting too much in detail. Then weighted average cost of capital with the growth rate calculation. Because sometimes what happens at the growth rate information is provided to us, which we are required to find using the dividend information. In that case also, again, going with the trial and error method, you are required to find the growth rate. Capital budgeting with inflation. However, from May 20 examination onwards, this concept has been dropped by institute. I have kept it over here to tell you that the 10 marks question was there from this concept in May 18 examination. The concept of the adjusted present value, which has been dropped again from May 18 examination onwards. 8 marks was the question which was asked from this, that is the concept. Now, going one by one with the concept, payback period was asked for 10 marks. Single project evaluation was again 10 marks. Capital rationing concept very less tested in examination. However, it was asked in examination for 5 marks. That is the way, say the 18, 10, 10 and 5. This is the marks weightage that we have, say, in the individual attempt. So the total comes to 43 and average comes to, we can say that's the 10.75 marks. That is the marks weightage given to, say, this chapter from examination point of view. Let us have a discussion further. Dear students, as we have name of the chapter as the investment decision. So what happens at say over here, in this chapter we are going to understand the decision to be taken for the investment. We will be provided with the different kind of situations, and in those situations we are going to take a decision. So this chapter is focusing about the decision making. What kind of situations may be provided to us for the purpose of decision making? The situations are like this: single project evaluation, mutually exclusive, so the investment opportunity, replacement of the machinery, then a situation of capital rationing, wherein we do not have the sufficient funds to accept, say, all the investment proposals. Then again, friends, the mutually exclusive investment opportunity with unequal lives, so that we are required to apply some modified method for the purpose of decision making. Like that, we will be provided with the different methods, that is the different situations in which we are required to take the decision. That is the first thing that you need to understand, that this chapter is technically about the decision making. The second thing, listen to me carefully, second thing, there are different decision making techniques that we have. The techniques that we have for the decision making are like this: net present value index, profitability index, or it is given a name as desirability factor, or it is given a name as benefit cost ratio, internal rate of return. Then we have the payback period, discounted payback period, and ARR. These are the different decision making techniques that we have. So there are different situations in which you have to take a decision, and there are different decision making techniques that we have for the purpose of decision making. Now, whenever it comes to the capital budgeting question or capital budgeting chapter, then in that case you have to see, let's say, whether you have been provided with any specific method to be followed for decision making, whether we have been provided with any specific method. If at all you have been provided with some specific method, then don't apply your mind. You just follow that instruction for the purpose of decision making. That's it. You do not have to apply your mind. You just have to follow that decision making technique. As I told you that there are 7 techniques that we have for the purpose of decision making. If at all there are certain mutually exclusive investment opportunity, means out of 2 you have to select only one. If at all the situation is like this, and you have been provided with any specific method for the decision making, then what you will do, if at all you have been provided to follow NPV criteria, you will select a project which is having the higher positive NPV. NPV index criteria, again higher NPV index will be followed. Then profitability index criteria, higher profitability index will be followed, that is will be accepted. Internal rate of return, higher IRR. Payback period, lower payback period. Discounted payback period, again lower discounted payback period. Average rate of return or accounting rate of return, higher ARR will be accepted. This is the way we are required to make the selection. If at all we have not been provided with any instruction, then in that case what you should do? Then in that case, you are required to make the selection of the decision making technique like this. Dear students, if it is single project evaluation, that is, the question is about the manufacturing of a product, the question is about the expansion of the existing business, like that, it is the single project evaluation. Then in that case you can follow NPV, or you can follow NPV index, or you can follow profitability index, or you can follow the IRR criteria. Any one of the criteria can be followed for the purpose of decision making. All of them will lead to the same conclusion. This is what we understand. Next, if at all there is a situation of the capital rationing, then in that case you are required to see whether the projects are indivisible or whether the projects are divisible. Divisible means you can accept the project partially. You can accept the project to some extent if at all you do not have the funds to accept the entire project. Then in that case you will follow the PI criteria or NPV index criteria for the purpose of ranking of the proposal, and based on that you will do the selection. In case of indivisible, you will go with the combination of the projects criteria. And accordingly you will have the selection. Combination will be formed in such a way that none of the combination is having the requirement of the funds exceeding the funds availability. Suppose we have an amount of 15 lakhs. Then individual projects, that total should not exceed 15 lakhs. And whatever the unutilized funds in any of the combination is not sufficient to accept a profitable project which has not been accepted in that combination so far. That is the way you are required to go for the combinations, and the combination which is having the highest NPV, that combination will be selected. This is the way we are supposed to do the selection of the proposals. Okay, so divisible, indivisible, in that case you are required to do like this. If at all there is a situation of mutually exclusive investment opportunity with unequal lives, then in that case, if at all the projects are of one-time acceptance, you have not been provided with any criteria. We have not been provided with any of the criteria, that's which criteria to be followed. However, you have to decide on your own. Then you have to see if it is of one-time acceptance, then in that case you will follow NPV criteria. And if it is of the repetitive in nature, then in that case you are required to follow the equalized annual criteria. Equalize the annual criteria for the purpose of decision making. This is the way we are required to take the decision. So in different situations, if at all the decision making technique is not specified, what to do, that kind of clarification I have given to you. Now I am going for the revision of one by one techniques. NPV, net present value. How do you make the computation? Present value of the cash inflow minus investment. Based on NPV criteria, when the project is selected, NPV is greater than 0, then you accept the project. NPV is less than 0, then in that case you reject the project. NPV is equal to 0, then in that case you are indifferent whether to accept the project or not. For the purpose of calculation of the NPV, we require the cash inflow. So we are required to make the computation of the projected cash flows, and the same will be discounted with the company's cost of capital for the purpose of NPV calculation. In computation of the cash flows, because that is something which is going to be important. See, computation of the NPV is not important. Computation of NPV is very simple. Computation of the cash flows are important. In that, so the important points are like this. As far as the depreciation is concerned, depreciation will be taken into account, so for the purpose of calculation of the cash flow. Why? Because depreciation is a non-cash item. We understand that so the depreciation is allowable expense from tax point of view. So we understand that so the depreciation is considered for the purpose of cash flow calculation. It is deducted before income tax calculation, then it is added back. This is the way the cash flow is supposed to be calculated. Next, as far as the working capital is concerned, with respect to the working capital, it is assumed in absence of any information that it is cash outflow when the project is initiated and it is cash inflow when the project is terminated. The reason for that is very simple. We understand that say the stock, debtors, net of the creditors is a working capital. It is required when you start the business, and when the business is over, at that time it is recovered from the business. That is the reason it is cash inflow at the end of the n number of years. Next, as far as the cash flow calculation is concerned, in that, so you are required to take into account the scrap value of the machinery when the project is terminated. At that point of time, so it is considered as cash inflow. Further friends, what happens at say, for the purpose of cash flow calculation, we may be provided with the information about the sunk cost. Then it will be ignored for the purpose of decision making. Any amount which has already been spent, any amount which has already been incurred, that does not form part of the decision making. If at all you have been provided with the information about the opportunity cost, then in that case it is considered to be the cash outflow before you compute the taxation. We understand logically like this, that say, suppose you are going to say expand your business, and for that say you require certain portion of the factory premises. Now that portion of the factory premises was supposed to be given on the rental. Then whatever the rental income that you could have received is an opportunity cost, and that is considered to be the cash outflow when we make the computation of the NPV. And importantly, it is supposed to be returned before making computation of the income tax. Why? Because if at all you would have received that rental income, then in that case you would have paid the income tax. That is the reason. So the opportunity cost information, if at all given, then that will be considered. Always remember that say any allocation, absorption, charge, recovery of overhead, if at all it is provided to us, then in that case it will be ignored for the purpose of income tax calculation. Why it is ignored? Because we understand that say it is not an incremental expenses. That is the reason it will be ignored for the purpose of cash flow calculation. This is the way the cash flow is supposed to be calculated. As far as the NPV index is concerned, NPV index is indicating what is NPV for every 1 rupee of the investment that you have made in the project. So it is calculated as NPV upon investment. Then as far as the profitability index is concerned, it is present value of the cash inflow upon investment. Profitability index is indicating that say what is the present value of the cash inflow for every 1 rupee that you invest in the project. That is what the PI is indicating. Next is the internal rate of return. Internal rate of return is basically indicating a rate at which NPV of the project is 0. We understand logically like this, that say IRR is indicating a kind of break-even rate. At that point of time, NPV of the project is 0. So if at all the company's own cost of capital is less than IRR, then in that case the project should be accepted, and if it is more than IRR, the project would not be accepted. So we understand that the IRR, cost of capital and NPV. If at all the company's cost of capital is equal to IRR, NPV is 0. If at all the company's cost of capital is less than IRR, then in that case NPV is positive. If company's cost of capital is greater than IRR, then NPV is negative. So based on IRR criteria, the project would be selected like this. IRR greater than cost of capital, then in that case accept the project. IRR is less than cost of capital, then in that case reject the project. IRR is equal to cost of capital, then in that case you are indifferent whether to accept the project or not. Always remember friends, that taking into account the cash flow series, IRR is calculated. When we make the computation of the IRR at that point of time, the company's own cost of capital is not at all taken into account. It is like calculated using trial and error method. We are required to find the IRR, say by interpolation method. So what happens at say, we understand like this. With the increase in the cost of capital, NPV is falling down. So that is one rate at which NPV is positive. That is another rate at which NPV is negative. So what we are doing, so we are interpolating these two cost of capitals. With the interpolation of both of them, so we make the computation of the internal rate of return. That is the way, so we make the calculation of IRR. This is what we understand. Now dear students, for the purpose of IRR calculation, we can have the information that can be divided like this. First, the discounting factors, information not given. Discounting factors information have not been given. Then in that case, my suggestion to all of you is that keep less difference so far possible in IRR calculation. The reason behind that is, in final interpolation method, an assumption is made that both of them are having straight relationship. So what happens at actually the IRR is this, but taking this rate, that is the answer that we get in the final interpolation method. So always there is a margin of error, when you make the computation of IRR. So that margin of error will be more if at all you take more difference in final interpolation. So take less difference so far possible, and my suggestion is that keep it less than equal to 3%. That is what's my personal suggestion, taking into account the suggested answer of the institute. Okay, the second is that the information for the discounting factors have been given. The second thing is that the discounting factors information have been given. In that case, listen to me carefully. What will happen? You have to understand like this. Suppose you have been provided with only two discounting factors. Then in that case, usually one discounting factor will have positive NPV, another will have negative NPV, and using both of them, you'll make the calculation of IRR. In this case, the 3% difference you don't take into account. Use the given discounting factors for the purpose of IRR calculation, and usually my observation is that the institute is doing this. Okay, now suppose you have been provided with more than more than two discounting factors. Like cost of capital is given 15%, 20%, 25%, 30% and 35%. And let us assume that the IRR is 24%. then in that case, interpolating 15% and 35% is wrong. You don't have to do like that. You have to do interpolation of 20% and 25%. That is taking the least difference. That least difference may be more than 3%. However, taking the least difference into account, you are required to make the computation of IRR. So this is what I suggest you. That is the way, so the calculation of the IRR is made. Next is the calculation of the payback period. As far as the payback period is concerned, we understand that it is indicating the time period in which we are able to recover the investment that we have made in the business. That is what the payback period is indicating. Suppose the life of the project is 5 years and say we are able to recover the investment within 2 years, then in that case the payback period is 2 years. Now as far as the payback period is concerned, say based on payback period criteria, when you have to select the project, what you have to do, you are required to make the comparison of the actual payback period and standard payback period. If actual payback period is less, then in that case the project is accepted. If actual payback period is more, then in that case the project is rejected. If both of them are same, then in that case you are indifferent whether to accept the project or not. That is the way, say we are required to take the decision. Actual payback period is less, then in that case we accept the project. Actual payback period is more, then in that case the project is rejected. This is what we understand. In case of mutually exclusive investment proposal, the project, that is a project which is having say the comparatively lower payback period and say less than the standard payback period, will be accepted. This is what we understand. Importantly friends, the payback period is calculated, say ignoring the discounting concept. The amount of the absolute cash flows say are taken into account for the purpose of payback period calculation. So the concept of the discounting is ignored. That is the limitation of the payback period. Another limitation is that say if at all you are able to recover investment in 2 years, then in that case say the payback period is 2 years. But what happens in the remaining number of years is not at all taken into account. Between two projects, it may happen that say one of the project is having say the shorter payback period. However, the later on the amount of the cash flow is very less, while the other project is having say the lower cash accruals initially and later on it is having say the huge cash accruals. That differentiation is not taken into account as far as the payback period is concerned. Next is so the discounted payback period. As far as the discounted payback period is concerned, it is a payback period criteria in which the concept of the time value of money is taken into account. Simple. We take into account the concept of the time value of money in calculation of the payback period, and it is called the discounted payback period. So the cash flows are discounted and then its cumulative value is calculated to see what is the time period in which we are able to recover the investment. For example, first year, second year, third year, fourth year. Cash flows, present value factor, present value, present value, present value, present value. Then cumulative value, cumulative value, cumulative value, cumulative value. That is the way, so we make the computation of the cumulative value. Then we have to see that say what is the time period in which we are able to recover the investment. Suppose the cumulative value is 1000, 3000, 8000 and 10,000. And we have made investment of, let us say, an amount of 6,500, suppose. So the amount of investment has been recovered after 2 years but before 3 years. So the discounted payback period is 2 years plus, you have to see 6,500 is the investment that you have made, and by end of second year 3,000 is recovered. So 6,500 minus 3,000. So what is the amount yet to be recovered? 3,500. What is the third year cash flow? This third year, that is present value cash flow, must be 5,000. So 3,500 divided by 5,000, that comes to 0.7 year. So it comes to 2.7 years. That is the way we make the computation of the discounted payback period for the purpose of calculation. This is also the concept that we have, which we are required to follow. Again, the limitation is same. That's the amount that you are going to receive after the payback period is ignored for the purpose of decision making. As far as the ARR is concerned, for ARR calculation, we may be provided that compute the ARR using the initial investment, or we may be provided so you are required to use the average investment. If it is initial investment, then in that case it is average profit divided by initial investment. And in case of average investment, it is the average profit upon average investment. How do we compute the average investment? Average investment is calculated as initial investment plus scrap value divided by 2. Multiply with 100 for getting answer in percentage term. This is the way so the answer is calculated. ARR. Mostly the clarity will be provided to us in example that say whether you are required to use the initial investment or you are required to use the average investment. If such clarity is not made, then in that case, either of the way you have to do answer and you put a note for the same. This is the way the ARR is calculated. The next is, we understand in case of the replacement questions. Dear students, in case of the question about the replacement of the machinery, we are provided usually with the information that the company is considering to replace a machinery, that is purchasing of the new machinery over the existing machinery. So that say what it can have, the first thing that say it can have the more capacity say to produce the product. It may be able to produce the product at the lower value, so the cost will reduce, say if at all the company is replacing the existing machinery. The next thing which is possible is that the company would be able to say increase the price. Why? Because the quality of the product has that is improved. And so on may be the reason for going with the new machinery over the existing one. In this kind of replacement question, you can do the question usually either by adopting the whole project point of view, we can do answer either with the whole project point of view, or otherwise we can do answer with the incremental approach. In adopting incremental approach, you just have to make sure that the balance life of the existing machinery and life of the new machinery are same. In case of whole project point of view, you compute the NPV for existing machinery, if at all you continue with the existing machinery, and for the new machinery, if at all you replace the existing machinery with the new machinery. If at all you purchase the new machinery, then in that case, importantly, the sale value of the existing machinery will be considered as cash inflow. Difference of the WDV of existing machinery and sale value of existing machinery, that is considered to be the capital gain or loss, and its tax effect is required to be considered. This is what we have in case of new machinery. Second important thing that you have to understand is that if at all you replace that is existing machinery with new machinery, then the purchase price of the new machinery will be cash outflow. That is the way we are required to make the calculation of answer. In case of incremental approach, we understand that in the last year, whatever the sale value that you receive of the new machinery is cash inflow, and sale value of the old machinery that you could have received will be considered as cash outflow. So these are the things that you should take care, say in case of incremental approach with the replacement of the machinery. Now friends, in case of mutually exclusive options in which the time period is different. Suppose you are considering to purchase either machinery A or machinery B. You are considering to purchase either of the machinery. Machinery A has a life of 3 years and machinery B has life of 4 years. You are provided only with the cost information. What is the purchase price, what is the running cost, what is the scrap value, like that, only that much information is given to us with respect to both of them. No revenue information is given. Why? Because the revenue is going to remain same for both the options. Suppose it is like this. Then what we are required to do, dear students, we are required to compute the present value cash outflow for each of the option. The present value cash outflow will be divided with the number of years, and with that, so we make the computation of the equalized annual cash outflow. And in order to incorporate the concept of time value of money, instead of only number of years, the annuity factor for that number of years will be taken into account. And with that, so we make the computation of the equalized annual cash outflow. Dear students, the term equalized annual cash outflow means that what is the annual cash flow for each of the machinery. The option which is having the lower equalized annual cash outflow will be selected. That is the way we are required to take the decision. Now there is one more point to which I want to draw your attention is modified internal rate of return. Dear students, the normal IRR calculation makes an assumption that the internal cash accruals can be reinvested at IRR rate, which is wrong. If at all the company's cost of capital is, let us say 10% and IRR is 25%, then IRR criteria assumes that the internal cash accruals can be reinvested at 25%, which is wrong. In order to overcome this limitation, we have a concept that is given a name as modified IRR, in which what we are doing, first year, second year, third year, fourth year and fifth year. Whatever the cash accruals that we have on the yearly basis, those cash accruals will be compounded till end of fifth year. For the purpose of this compounding, we will be provided with the cost of capital of the company. We will be provided with the information about the reinvestment rate. In the year 0, we make investment and say taking into account say this year 0 cash outflow and the future value of the internal cash accruals, we are required to make the computation of the modified internal rate of return. It will be calculated like this: investment into future value interest factor at modified internal rate of return for n number of years is equal to future value of internal cash accruals. This is what we understand. Is that clear, all of you? Fine. This is a modified internal rate of return. As far as the IRR criteria is concerned, it is suffering from the limitations. In that, this is one of the major limitations that IRR criteria has. Another limitation is that if at all there is a cash flow series like this, year 0 outflow, year 1 inflow and year 2 outflow, then for this kind of cash flow series, we have a situation of multiple IRR. Multiple IRR means there is more than one discounting rate at which NPV of the project is 0. So it's like the diagram is like this. Okay, one more thing is year 0, year 1, year 2, inflow, outflow and inflow. If at all there is a situation like this, again in the situation we have multiple IRR, wherein we will be having more than one discounting rate at which NPV of the project is 0. That is called multiple IRR. In case of multiple IRR, the decision making is possible. However, that decision making is going to be complicated. This is what you need to understand from the IRR point of view. Further, we understand that there can be three situations in which there could be a conflict in the ranking of the proposal. That is between NPV and IRR, so there will be a conflict. That NPV criteria would suggest that the project A is better than B, and IRR would say that B is better than A. That kind of conflict that can be there in three situations. The three situations like this. First is that the initial investment differs. The second is that the lives of the project differ. And projects are of one-time acceptance. And the third situation in which the pattern of the cash flow series differ. In these three situations, it may happen like this. Dear students, here there is an example. Project C and project D. What we can see? We can see that the project C has higher positive NPV and project D has higher IRR. Cost of capital of the company is provided to us as 10%. Return is higher for both the projects, higher than 10%. But project D has more IRR than C. And NPV, C has more than D. That is the way conflict is there. I told you that there can be one of the three reasons, and over here it is the third reason. Wherein the pattern of the cash flow series is different. It is high to low, and over here it is low to high. That is the way we have the different pattern of the cash flow series. Again, you can see that the initial investment differs. Project A 10,000, project B 5 lakhs. And we can see that for 5% discounting factor, B has more NPV than A. Internal rate of return, A has more IRR than B. That kind of conflict that can be there. Again, lives of the project differ. Project A 1 year life, project B 5 years life. NPV of B is more than A and IRR of A is more than B. That kind of conflict is there. There are two things that I want to tell you further. One thing is that we may be provided with the situation. We may be provided with the information that there is change in working capital requirement. That kind of information may be provided to us. That year 0, year 1, year 2, year 3, year 4, 100, 200, 600, 350 and 400. Suppose like that, the information is given that the working capital requirement is there. Then we have to understand that when we compute the cash flows at that time, 100 is outflow for year 0. Now investment of 200 is required. We already have 100, so additional investment of 100 will be required. We want 600, we already have 200, so additional 400 is required. We require 600, we have 350, so there will be a recovery of 250. We have 350, we require 400, so there is an additional investment of 50. Suppose 5th year end we close down the business, so there is a recovery of 400. This is the way we are required to make the changes of the working capital, and that will be useful for calculating the cash flow. One more thing which I told you that I want to explain you is this. That in calculation of NPV, it is present value of the cash inflow minus investment. Calculation of the profitability index, it is again present value of the cash inflow divided by investment. Calculation of the internal rate of return, that is such a discounting rate at which the present value of the cash inflow itself is investment. Now dear students, what happens importantly over here, that the present value cash inflow for NPV and present value of the cash inflow in case of PI, both present value cash inflow are same. That is cash flows discounted with the company's cost of capital. Why? Say this present value cash inflow is different. Why? Because this present value cash inflow is indicating that the cash flows discounted at the IRR rate. Cash flows are same. Over here, the discounting factor is cost of capital, and over here the discounting factor is IRR. In case of the missing figure information, this kind of, say, the bifurcation is very necessary for you to understand. Now the theory questions which have been asked, one is the desirability factor or profitability index. NPV and IRR, this is what asked for. Then IRR. Distinguish between the NPV and IRR for evaluating. Again, like you can see, that's the repetition. Which method of comparing a number of investment proposals is most suited if proposal involves different amount of the cash inflow? Explain and state its limitations. Explain sale and leaseback. Then explain the steps while using the equalized annual criteria. That is how the steps are required to be applied. That is what the question is. So these are the questions which have been asked from the chapter of the capital budgeting in form of theory questions. Starting with the next chapter, that is risk analysis in capital budgeting. Risk analysis in capital budgeting. Let us see that, say, what are the learning points and what have been importance of this chapter in examination. The different concept that we have is probability distribution method of NPV calculation. That is, we will be provided with the probabilities, cash flows. We have to compute the expected cash flows. Expected cash flows are discounted in present value term, and with that, say, the NPV can be calculated. Then variance and standard deviation calculation. Again, something that, say, we understand, we study in statistics. Then it is coefficient of variation, CV criteria, for the purpose of measuring what is the risk for every 1 unit of return. NPV using the risk adjusted discounting rate. If at all the risk of the project is more, then you apply more discounting rate for the purpose of NPV calculation. Certainty equivalent method of NPV calculation. This is a method by which we are incorporating risk in capital budgeting decision. Sensitivity analysis, scenario analysis. Simulation analysis is a concept, however, from May 20 onwards, it has been dropped. Decision tree, again, it has been dropped from May 20 onwards. From examination point of view, it has been asked for 5 marks, total 10 marks from this concept. 5-4, total 9 marks. 2 marks theory, that is the decision tree. Like that, so the 21 marks in total, and on an average it is of 5 marks. That is the way we have the importance from examination point of view. I would say that this is a very simple chapter in which we are provided with some very simple information, and based on that, the NPV is required to be calculated. The first is a concept in which we have the probability distribution method of NPV calculation. Cash flows along with the probability. So we are required to find the mean cash flow. Then the expected cash flows will be discounted in present value term. From present value of the cash inflow, investment is deducted to find NPV. This is the first method. So something like this information is given. First year, second year, and third year. Cash flows, probability. Similarly second, similarly third. That is the way the mean cash flow is calculated, expected cash flows discounted, and with that NPV is found. As far as the variance is concerned, friends, in that case what happens? It is the probability cash flow. Let us assign X variable to it. Probability into X. That is the way we make the computation of the X bar, that is mean. Afterwards, we make the calculation of x minus x bar. Then we make the calculation of x minus x bar whole square. Then we multiply with the probability. Summation of that is considered to be the variance. And under root of the same is the standard deviation. That is the way the standard deviation is calculated. Standard deviation is indicating the volatility of the expected value. Then we make the computation of the CV, coefficient of variation. It is calculated as risk upon return. Risk is measured in form of standard deviation. Return is measured in form of mean value. That is the way the CV is calculated. In case of friends, calculation of the risk adjusted NPV is concerned, we understand that say more risk, with that say the higher the discounting rate. You have been provided with the investment, you have been provided with the cash inflow, life of the project. CV is 1.2. Now based on the CV, we determine the discounting rate which is supposed to be applied, and accordingly, so we'll make the calculation of NPV. Lower the CV, lower the discounting rate, and vice versa. Friends, I am discussing one of the recent questions asked in examination. We have been provided with the information about two projects, X and Y. The investment is same. Time period of the project is 8 years. Pessimistic, most likely, and optimistic. In the three situations, the cash flows have been given. In case of most likely, cash flow is same. So of course, NPV is going to be same. In case of pessimistic, cash flow of X is higher than Y. And in case of optimistic, cash flow of Y is more than X. So of course, the answer is going to be that say in case of pessimistic situation, NPV of X is more than Y. And in case of optimistic situation, NPV of Y is more than X. And in case of most likely, NPV is going to be same in both the cases. So what to do? Which project to be accepted? Very good answer is provided by the institute that depending upon your risk bearing capacity, you should accept the project. What will happen in case of the project X? We can see that the variation is less. Like 28,000, that is 26,000 and 36,000. So over here, if at all, say we see the comparison from the most likely, over here it is only 2,000 rupees of the reduction, and over here it increases only by 8,000. In case of project Y, it reduces substantially. It reduces by approximately 16,000. And the same project, in that say the cash flow increases by approximately 24,000. So as far as the project X is concerned, its volatility is this. And for the project Y is concerned, its volatility is this. So very good answer is provided by them that depending upon your own ability to bear the risk, you should make the selection. You have more risk bearing capacity, you should go for a project which is having say the higher volatility, and so you will be able to get the higher return as well, and vice versa. This is the way we are supposed to select the answer. Now I am discussing with you the next technique, that is called certainty equivalent technique. Dear students, we will be provided with the information about the cash flows. We will be provided with the information about the C factor. Cash flows are multiplied with the C factor, and with that say we convert that into risk-free cash flow. C factor is indicating that say from every 1 rupee of the cash flow, you are certain to what extent. So product of this two is the risk-free cash flow for the first year, risk-free cash flow for the second year. The same will be discounted with the risk-free rate of return, that is return on the Government of India bond. And with that, the NPV is calculated. So this is the way you incorporate the risk in capital budgeting decision. That is the first thing. Second thing that I want to tell you is this. The question may be asked that say, which project is comparatively more risky? What do we observe? We observe like this, that the project X has lower C factor than Y in the first year. Project X has lower C factor than Y in the second year. So the project which is having consistently the lower C factor will have the more risk. Why? Because it has more uncertainty, and accordingly it will be discounted with the higher cost of capital. This is the way we are required to write the conclusion. The next concept is that we have is sensitivity analysis. This is one of the very important segment that we have. Dear students, we understand that there are a number of factors which are taken together for the purpose of NPV. Like selling price per unit, direct material cost per unit, direct wages cost per unit, variable overhead cost per unit, then fixed cost, then sales units, life of the project, investment. Like that, so there are not this only, but still more number of factors are there which are considered for the purpose of NPV calculation. Now we understand that the adverse change in any of the factor is going to have the bad effect on the NPV. If at all the selling price reduces, if direct material cost increases, direct wages cost increases, variable overhead cost per unit increases, fixed cost increases, sales units is falling down, life of the project is reducing, investment is going up, all these will have the poor effect on or bad impact on the NPV of the project, and NPV is bound to decrease with these adverse changes. So the sensitivity analysis is measuring that what would be the effect for this adverse changes. If selling price reduces, then in that case, what is the effect on NPV? Of course, every time NPV of the project is going to fall down. However, the factor due to which the NPV of the project is falling by the maximum amount is considered to be the most sensitive factor to the project. Every time NPV is going to fall down. However, the factor due to which NPV of the project is falling by the maximum amount is considered to be the most sensitive to the project. Importantly, sensitivity analysis makes an assumption that there is only one change at one point of time. There is only one change at one point of time. That is the kind of the assumption which has been made for the purpose of the measuring sensitivity analysis. This is what we understand. Next is given a name as scenario analysis. Dear students, as far as the sensitivity analysis is concerned, it has a limitation. It assumes that there is only one change at one point of time. But actually that is not true. All the factors are interconnected. So if at all the selling price reduces, there are fair chances that the sales quantity will increase. If at all the company is incurring more advertisement expense, then there are fair chances that the sales quantity will increase. These kind of combined effect is not considered by the sensitivity analysis, and to overcome that limitation, we have scenario analysis, in which we take into account all these changes together, and with that NPV is calculated. Let us see the theory portion. Of course, all the questions which I am going to tell you is of the intermediate only, because this is a chapter which has been brought down from CA final to CA intermediate when from May 18 the new syllabus was incorporated. The first is, what is certainty equivalent? We understand that it is indicating that from every 1 rupee of the expected cash flow, you are certain to what extent. Next, explain two main reasons considering risk in capital budgeting decisions. Third is steps in sensitivity analysis. Next, explain any two steps involved in the decision tree analysis. However, now there is no need to do this question. The reason is that the decision tree is now lapsed. Now starting with the next chapter, name of the chapter is dividend decisions. First of all, discussing the concept that we have. The first is very simple, growth rate calculation based on the Gordon model. Then the Gordon model of the dividend policy, Walter model, then combination, because a question was asked consisting of both of them. Then MM approach, Modi-Gila limited approach. Next is the Graham and Dodd model, stock split and Lintner model. Out of 4, in 3 examinations it has been asked upon. So the average is 3.75, or we can say that on an average for 5 marks it is asked in examination. Now friends, as per the chapter of the dividend decision is concerned, in that say, what are the learning points? Let us have a discussion of the same. We understand that say, once the company has the earning after taxes, from that the payment of the preference dividend and payment of the equity dividend is concerned, these 2 payments are made. Now when you make the payment of the preference dividend, then in that case, as far as the rate of preference dividend is concerned, it is predetermined. You don't have to decide that say every year. There is only one condition that say you have to understand, is that say before you pay anything to the equity shareholders, you are required to make payment to the preference shareholders. Payment of the interest is unconditional, that you have to pay every time. After making payment of the preference dividend, whatever the earning available to equity shareholders that you have, from that earning available to equity shareholders, making payment of the equity dividend is voluntary, and making payment of the equity dividend at which rate, that the company is required to decide on its own. There are no rules and regulations, there is no mandatory law which provides that say what amount of the equity dividend to be paid. So this chapter is with an intention to understand that say what amount of the equity dividend which the company has to pay is what we are going to understand. So first of all, you try to understand and say what is the logic of this chapter. Fine? Okay. I hope that the logic of the chapter is clear to all of you. See, when we study the chapter of the capital structure theory, we have net income approach, net operating income approach, Modi-Gilani Miller approach, that is traditional picking theory like that. Exactly the same thing that say we have over here, we have the different dividend policy theories. We have like the expert's opinion, like Gordon model, then Walter model, again Modi-Gilani Miller approach, Lintner model, and Graham and Dodd model. Here are the experts who have given their opinion that say what the company should do in terms of say making payment of equity dividend. Again, the objective over here is say the maximization of the wealth of the shareholders. Maximization of wealth of shareholders. Dear students, wealth of the shareholder is measured in form of say the market price of equity share. So we have an intention that say how we should make the payment of dividend, or how we should say decide about the equity dividend payment, so that say ultimately say it is able to contribute in terms of the maximization, in terms of the increase in wealth of the shareholders. That is what we understand. Let us talk about say first of all say the Gordon model. We understand that there are 3 things that say you should understand from the revision point of view, first is the assumptions of the Gordon model. Second is formula and based on that the calculation. And third is conclusion, that's about the dividend payment. These are the three things that we have. As far as the assumptions are concerned, the assumptions are like this. The first assumption, that there is only equity financing. There is no debt financing. Second assumption is that the company will be having the same rate of earning, same cost of equity, then same dividend policy. Then the capital market is perfect. Then there is no flotation cost, no transaction cost, and so on. These are the assumptions which have been made, by the Gordon model for the purpose of establishing his dividend policy theory. The formula for calculation of the market price of the equity share is very simple. P0 is equal to D1 divided by K minus E. It is exactly the same formula that you study in cost of capital, D1 divided by P0 plus G. Simplification of this formula is like the P0 formula that we have. As far as the growth rate is concerned, growth rate is calculated as B into R. B stands for retention ratio, R stands for the rate of earning. The conclusion that you draw with respect to the payment of the dividend is like this. You are required to make a comparison that what is the rate at which the shareholder is able to earn from the business, what is the rate at which the company is able to earn from the business, and what is the rate at which the shareholder can earn if the funds are given to the shareholder for making investment somewhere else. What is the opportunity cost of the equity shareholders is measured by way of cost of equity, and what is the rate of earning of the company is measured by way of R. So if at all R is exceeding K, then in that case we understand that the company should retain maximum earning. The company should retain maximum earning. If R is less than K, then in that case what the company should do, company should distribute 100% earning in form of dividend. And if R and K are the same, then in that case, irrespective of dividend payout ratio, price of equity share is going to remain same. In the first case, you do like this, with that the price of equity share will increase. In the second case, you do like this, with that the price of equity share will increase. Doing the reverse, of course the price will fall down. In the third case, whatever may be the dividend payout ratio, the price of equity share is going to remain same. That is a simple theory that we have. This is what's the Gordon model. Next is Walter model. As far as the Walter model is concerned, its assumptions are very much similar to the Gordon model. Gordon model has made one more assumption, that cost of equity is exceeding the growth rate. That assumption is required, otherwise the solution of the equation is not possible. That assumption has not been made by the Walter model, otherwise majority of the assumptions are same. As far as the formula for market price of the equity share calculation is concerned, the formula is slightly different. The formula is like this: dividend per share plus earning per share minus dividend per share into R divided by K whole divided by cost of equity. With that, we make the computation of the market price of the equity share. First of all, dear students, you have to make sure that you solve this equation. After solving this equation, you add dividend per share to it, and whatever the numerator is divided by cost of equity in order to make the calculation of the P0, that is market price of the equity share. This is what we are required to do by using the Walter model. As far as the Walter model is concerned, its conclusion is very much similar to the Gordon model. When comparison is required to be made, the company's own rate of earning with the shareholders' opportunity to invest the fund somewhere else. If the company is able to earn at a higher rate, then in that case the company should retain 100%, and with that the price of the equity share will increase. If R is less than K, then in that case you should distribute 100%, and with that again the price of equity share will increase. If R and K are the same, then in that case again, irrespective of the dividend payout ratio, market price of the equity share will remain same. That is the way we are required to say have the dividend policy theory. This is the Gordon model and Walter model. Now friends, over here, just I want to explain you like this. A firm was started a year ago with an equity capital of 20 lakhs. So 1 year before the company was started. In respect of this firm, the following information is available. Earning of the firm, that is 2 lakhs. Investment was made at the beginning of the year 20 lakhs. At the end of the year, earning is 2 lakhs. So we can say that the rate of earning of the company is 10%. Fine. Amount of the dividend paid 1,50,000. This is an important information. Price earning ratio is given 12.5 times. Number of equity shares and everything is given. The question says that whether the current dividend payout ratio is optimal as per the Walter model. Now always remember that whenever it comes to the Walter model and you are required to draw a conclusion that whether the current dividend payout ratio is correct or not, then in that case you are required to make a comparison of the R and K. As I explained you orally, R is 10%. Now for cost of equity, say what happens that over here the only information which is provided to us is about the price earning ratio. As per the formulas which I have explained to you earlier, the price earning ratio is MPS upon EPS. That is the way we have the price earning ratio as a formula. Now for cost of equity calculation using the earning approach, the formula is EPS upon MPS. Now looking to these two formulas simultaneously, what we can say that the cost of equity is nothing else but it is 1 upon price earning ratio. So in this special situation, the cost of equity will be calculated as 1 upon price earning ratio, that is 1 divided by 12.5, that comes to 8%, and we understand that 8% is lower than 10%, so the company should have retained, instead of that the company has distributed, so the current dividend that is policy is not optimum according to Walter. This is the conclusion that we draw. Second question, again I think that it is important, so I am discussing what should be the price earning ratio at which dividend payout ratio will have no impact on the value of the shares. What should be the price earning ratio at which whatever may be the dividend payout ratio, the price of the equity share is going to remain same. We understand, dear students, that if at all there is a situation that R and K are same, at that point of time it happens like this, that whatever may be the dividend payout ratio, price of equity share is going to remain same. That is the first thing. Now we understand that as far as the cost of equity is concerned, cost of equity is 1 upon price earning ratio. The answer is required to be given in form of price earning ratio. So it is 1 upon K. We can observe that the rate of earning of the company is 10%. Now if at all the cost of equity is equal to rate of earning, if the cost of equity is equal to rate of earning, then in that case whatever may be the dividend payout ratio, price will remain same. So it is 1 divided by 10%, that comes to 10 times. This is the way we understand that the price earning ratio answer can be given for the purpose of, say, giving answer. Next question that I want to discuss with you is this. Information is provided that say using the Walter formula and Gordon formula calculate the price. Okay. You have been provided with the information about the dividend per share 10. Sorry, earning per share 10, dividend per share is 6. So what is retained earning 4? If you retain rupees 4 out of 10 rupees that say you have earned, can we say that the retention ratio is 40%? Yes. Cost of capital is 20, fine. Internal rate of return is 25%, is also fine. And you can see that the retention ratio given to us in the question is 60%. And you can see that the both of them differ. Whatever the retention ratio I explained to you orally was 40%. And what we can see over here is 60%. Whether both of them tally? No, both of them do not tally. Now this is what we understand is a kind of situation that you may come across in examination. Question from institute publication. My suggestion to all of you is that either you ignore this retention ratio and you do an entire answer, or otherwise you ignore this dividend per share and you do entire answer. You do answer by taking one of the information and you ignore the other one. Next is MM approach. Let us have understanding with respect to the MM approach. As far as assumptions are concerned, the assumptions are same over here once again with certain additional assumptions like this. The first assumption additionally that the investor is indifferent whether he is getting return in form of dividend or he is getting return in form of change in the price of the security. So investor point of view, this additional assumption is made. Second assumption which is made is that the investment plan of the company is independent of the dividend distribution. If at all the company is making payment of more dividend, then in that case the retained earning will be less, and to expand the business, more number of equity shares are required to be issued. If at all the dividend amount is less, then the retained earning will be more, and for expansion, less number of equity shares are required to be issued. So importantly, the assumption is made that the investment is independent of the dividend distribution. And the capital market is perfect, no flotation cost, all those assumptions are always there. So the first is assumption. Second is formula. Now dear students, over here, suppose the question says that you are required to make the computation of the current value of the firm. Then in that case, usually there are 3 steps in which we make the computation. Usually, you might have studied something here or there, but usually I think that there are 3 steps. Step number 1 is calculation of the price of equity share at the end of the year, P1. Step number 2 is delta N, that is the change in the number of equity shares. And third is current value of the firm. As far as the P1 is concerned, it is calculated by using a simple formula like this. P0 into 1 plus D, that is the way it is calculated. The compounded value at the end of the year minus D1. That is the way the P1 is calculated. Over here the logic of the formula is very simple. That is 1 plus K. P0 into 1 plus K minus D1. That is the way the P1 is calculated. As far as the delta N is concerned, it is calculated something like this. Listen to me carefully. We understand that the earning of the company minus ND1. Whatever you earn, from that the dividend distribution is subtracted. So that is the retained earning. This amount of the retained earning is deducted from the investment. So whatever the amount that you are going to invest minus retained earning, difference of that is considered to be the amount of the new financing that you have to raise, divided by P1, because that amount divided by P1 is indicating the additional number of equity shares which are required to be issued to finance the requirement of the balance funds. So these are the additional number of shares which are required to be issued to finance the requirement of the balance funds. And then dear students, we will calculate the NP0. It is N plus delta N. N stands for the existing shares. Delta N stands for the additional number of shares issued at the end of the year. Into P1 minus investment plus profit of the company divided by 1 plus K. This is the simple formula to be applied for the purpose of NP0. Now the conclusion, as far as the MM theory is concerned, it has a simple conclusion that you forget about the dividend as a tool by which you will be able to maximize the shareholders' wealth. The conclusion is that whatever may be amount of equity dividend payment, always value of the firm is going to remain same. Because if at all you pay more dividend, then price of the security will fall down to that extent, and vice versa. That is the reason, say, always the current value of the firm is going to remain same, wealth of the shareholder is going to remain same, whatever may be the dividend payment. This is what we understand. The next is the Graham and Dodd model. Dear students, this is not a very successful dividend policy theory. So I am just discussing with you that the conclusion that it has. This theory has a simple conclusion that say the amount of dividend should be equal to the earning. You pay dividend so far possible. More and more earning is paid in form of dividend. With that, the price of the equity share increases. That is the simple conclusion that say we have of this dividend policy theory. Over here, the market price of the equity share is calculated by using a formula like this, that dividend per share plus earning per share divided by 3 whole into multiplier, and with that the market price of the equity share is calculated. This is the simple formula which is required to be applied. The simple conclusion is that say 100% of the earning to be paid in form of dividend, and with that the price of the equity share increases. Next is Linton model. As far as this dividend policy theory is concerned, this theory says like this, that every year you have to make sure that say you are making payment of the dividend which is at least equal to the previous year's dividend. That is what the theory says. So dividend per share of the current year is equal to previous year's dividend per share plus. Now what is the additional dividend to be paid? It is calculated like this, earning per share into dividend payout ratio. That is the amount of dividend that you get minus previous year dividend per share, because the previous year dividend per share has already been mentioned over here. So from this amount, the previous year dividend per share is subtracted. So difference of that is considered to be a kind of incremental earning to be paid in form of dividend. However, the entire incremental earning may not be paid in form of dividend, and it will be adjusted with a factor, and that is given a name as the adjustment rate. So into C, that is the adjustment rate. So this is the additional dividend to be paid apart from the previous year's dividend in order to compute the amount of dividend per share. There is no theory question asked from this chapter. Further, there is a concept that is given a name as the stock split. Stock split means that the more number of shares are issued to the existing shareholders in comparison to the number of shares that they are holding. Face value is 10. Then, like the 2 equity shares of the face value of 5 is issued against 1 equity share. The reason for that is to reduce the price per equity share. Reducing the price per equity share will allow more number of investors to make investment in that security. If at all the price per equity share reduces, then in that case the base of the shareholders can be increased. This is also the reason because of which there is a stock split. Next is the chapter working capital management. First of all, let us see from examination point of view the concept that we have. Calculation of the creditors for a newly formed company. That is what I have done. Calculation of the creditors turnover ratio for an existing company. Working capital requirement for a newly formed company. 10 marks question for in May 18. Working capital requirement for an existing company. Again 10 marks question. It was in May 19. Then working capital for existing company, if it is increasing, so the level of activity, if it is shifting to the double shift, then the concept of the working capital cycle. And based on that, so the working capital requirement, working capital turnover ratio or cash turnover ratio, then working capital policy. It may be conservative, it may be aggressive, it may be moderate. And then financing of the working capital policy. Again, conservative, moderate and aggressive. 2 times 10 marks question have been asked. Average becomes 5. However, we understand that whenever it will be asked, it will be usually for 10 marks, it will be asked in examination. Now let us have a discussion for the working capital management chapter. Dear students, what happens at, first of all, importantly, the purpose of learning the chapter is to make an estimation that what would be the working capital requirement in the business. I start one by one with the explanation. Suppose we have started a business on 1st of April 2020. That is the date on which we have started the business. End of year 1 is 31st of March 2021. At this point of time, what would be the working capital investment that we are going to have? That kind of projection is made at this point of time. And this is what we understand is about the working capital management chapter. Over here we are going to understand that how to make a projection that at this point of time what would be the working capital investment that we will have in the business. This is the first thing that we understand. As far as the working capital calculation is concerned, we can divide the same like this. One is for the new company, you are required to work out the answer. Another is for the existing company that you are required to work out the answer. In case of existing company, there may be a situation that there is no change in activity level. Then we may be provided that there is a change in activity level. And lastly, there may be a situation that the company is going to work under double shift. Dear students, unless the question is specifically providing that the company is a newly formed company, we always assume that it is an existing company. In respect of existing company, again we make an assumption that there is no change in the activity level unless there is directly or indirectly information provided about the change in activity level or the company is going to work in the double shift. That is what we understand. Now, I am talking first of all about the new company. How to make the computation, how to make the estimation of the working capital requirement for the new company. Usually, we are provided with the information about the working capital to be computed for a manufacturing concern. That is what usually we will be provided with the information. So we will be having the working capital consisting of stock of raw material, stock of work in progress, finished goods stock, then debtors, then cash and bank, then there may be some prepaid expenses or advance expenses. Next, we may be having some advance tax, then income tax provision, then we may be having creditors for expenses, it may be for direct wages, it may be for administration, factory overhead, selling overhead, something like that. Then creditors for raw material. This is the way what happens at say from the current assets. Current liabilities will be deducted, will calculate the working capital. Sometimes we are provided with information about the margin for contingencies. If at all such margin for contingencies information have not been given, then in that case, this is the answer that we have. If such information is given, then in that case, working capital before margin for contingencies, then margin for contingencies will be added, and total of both of them is the total working capital requirement that we have. This is the way we are required to calculate the working capital requirement. This is what usually that we are required to do. Next, there are certain important things. As far as WIP valuation is concerned, you can see that over here we have the WIP stock. Then for WIP calculation, we will ignore the depreciation. Why? Because depreciation is considered to be the non-cash item. Then for finished goods valuation, again, finished goods stock that we are going to compute over here. In that again we are going to ignore depreciation. Why? Because depreciation is a non-cash item. Then for debtors, we will ignore depreciation and at the same time we will ignore the profit. Why? Because we understand that the debtors is usually valued as the sales value. Now the sales value is consisting of two components, cost and the profit. Now for profit you do not have to make any investment, so we are eliminating the profit. We compute the total cost. In total cost also depreciation is included. So depreciation is deducted for the purpose of calculation of the debtors. So technically it is given a name as debtors are valued based on cash cost of credit sales. This is the way it is calculated. I generally suggest to students that for a new concern, you compute the working capital in 4 steps. Generally I suggest like this. Step number 1, in which I suggest you to make the computation of the WIP, work, that is work in progress. Second is the finished goods calculation. The third is cost of sales, that is cash cost of sales. And step number 4 is the working capital. These are the 4 steps in which we are required to work out the answer. As far as the WIP is concerned, usually we will be provided with information about the completion stage. The second is the finished goods. Third is the cash cost of the sales. Now for computation of the cash cost of the sales, I suggest to students to do like this. We start with the raw material consumption. Then we add direct wages. At this point of time, if required, compute the prime cost, otherwise it may not be required. Then we have the factory overhead. add opening WIP. Dear students, as it is the new concern, so the opening WIP would be 0, less closing WIP that we have computed in step number 1. So this gives us the works cost. That is what we understand. This is a question which is of the institute publication, which I want to connect before I proceed further. MA Limited is commencing a new project for manufacturing of the plastic component. The following cost structure has been ascertained for the annual production of 12,000 number of units, which is the full capacity. So friends, over here at full capacity of 12,000 number of units, this cost per unit is given. Now, if at all you produce more number of units or you produce less number of units, in either of the case, the total fixed cost is not going to change. Like the fixed manufacturing cost has been given. So it is 6 into 12,000, whatever may be the actual output. Depreciation being the fixed cost, then again 10 rupees per unit into 12,000. Then fixed administration expenses, so 4 into 12,000. And further importantly friends, it has been given, it is related to the factory. If at all the institute has given this kind of clarification, only in that case it will be considered as a part of the finished goods valuation. If it is not provided like this, then in that case it is not forming part of the finished goods valuation. Be careful. Regarding say the administration expenses, the way clarity was provided over here, like this the clarity is given, then in that case it will be considered as a part of the finished goods valuation, not otherwise. This is what we understand. Okay, so we get over here cost of goods produced add opening finished goods, which is 0. Why? Because it is a new concern. Less closing finished goods, which we have computed in step number 2. So we get COGS, that is cost of goods sold. Then we add over here administration overhead, we add over here selling overhead. Generally, except that is exceptional question I have shown you, generally the administration overhead is not included in the finished goods valuation. So we get over here cash cost of sales. This is step number 3, then step number 4. In step number 4, you compute the working capital. How do you make the computation of the working capital? As I told you, that you start with the raw material stock. Raw material stock is calculated as raw material consumption divided by 12 months into raw material holding period. Raw material consumption annual divided by 12, so you'll get the monthly consumption into raw material holding period. We may be provided with the number of days, then raw material consumption divided by number of days in a year, multiplied with the raw material holding period in terms of number of days. That is the way raw material stock will be calculated. WIP stock, for that step number 1 is what you have done. Finished goods stock, again the step number 1 that you have done. Debtors, in that case it is cash cost of credit sales divided by 12 months into average collection period. Cash and bank balance usually provided to us. Prepaid expenses, in that it is the annual expenses divided by 12 months into time period. That is the way the prepaid expenses is calculated. It is annual expense divided by 12 months in a year into time period. Advance tax, we will be provided with certain income tax that we are required to pay, and maybe 3/4 is paid in advance or 90% is paid in advance. That is with the advance tax. Income tax provision in total. Creditors for expenses, annual expense divided by 12 into average payment period. Creditors for raw material is important. Dear students, what happens is the creditors for raw material will always be calculated as annual credit purchase divided by 12 months into average payment period. This is the formula which we are required to apply. Now, what is the annual credit purchase? We understand that say for a new concern, the credit purchase will be calculated like this: closing plus consumption minus opening divided by 12 into average payment period. Now, for a new concern, so the opening value is 0. So the opening stock is going to be 0. So minus 0. Accordingly, we are required to make the computation of the creditors for raw material, and based on that, we will make the computation of the working capital. Then working capital before margin for contingencies, is added, and the total working capital is calculated. Suppose friends, we have been asked to prepare the projected profit and loss statement, then in that case depreciation will be considered. Why? Because the depreciation is an expense for the purpose of projection of the profit and loss. Now you can see that here is a question in which information is given that the sales is 2,10,000, COGS is 1,53,000, and information is given like this: material consumption 84,000, wages and manufacturing expenses 62,500, depreciation 23,500, so the total is 170, minus stock of finished goods 17,000. So this is the COGS. Now this finished goods valuation is made without taking into account the administration expenses. See, this is what I want to tell you, is that regarding the administration expenses, unless it has been given like in the previous question that it is related to the factory, we'll always assume that it is not supposed to be forming part of the finished goods valuation. See, in this question we have been provided provision for taxation 10,000. Then you can see that the information is provided that the 70% of the income tax will be paid in advance. Now it is paid on the quarterly installment, half-yearly installment, that is not supposed to be considered. Out of 10,000, 7,000 has been paid, yes, so 7,000 is advance tax and the 10,000 is income tax provision. With respect to the WIP, sometimes the information is given like this: assume 50% completion stage in respect of conversion cost, means for wages and overhead it is 50% complete. Material is issued at the start of the processing, means with respect to the WIP we have the material 100% completed. Why? Because the material is introduced at the beginning of the process. And regarding the conversion cost, the information is given that it is completed to the extent of 50%. Now dear students, we may be provided that it is not a new company, it is an existing company. Then my suggestion to students is that do answer in this 2 steps. Step number 1 is the cash cost of the sales, and step number 2 is the working capital. I explained to you that how you may be doing answer. The first is the raw material consumption, that you keep as it is, no change, direct wages as it is, factory overhead as it is, and then as far as the WIP is concerned, you are not supposed to write any of them, neither opening WIP nor closing. Why? Understand it carefully, dear students, that for an ongoing concern we will have an assumption that the opening and closing are same. That is the reason we need not to write either opening or closing. This is the works cost, or we can say that it is the cost of goods produced. Again, regarding finished goods, opening and closing is assumed to be same. That is the reason. Say neither you have to write opening nor you have to write closing. So this is the way the cost of goods sold is found. Administration and selling already decided, and you compute the work, that is the cash cost of the sales. That becomes your step number 1. In step number 2, listen to me carefully. Raw material stock as it is. For WIP, you need to prepare a separate working note. I agree with that. For WIP, you need to prepare a working note. Just one clarification I want to give you over here, that sometimes the question provides that the WIP holding period is 1 month. However, the completion stage information is not given by institute. Then in that case, you may assume 100% for raw material, 50% for direct wages and overhead. Generally make this assumption. If at all the clarification is not made, as what we have seen that the clarification should have been made. Finished goods as it is, like COGS divided by 12 months or 360 days, 365 days, whatever may be, into finished goods holding period. Data is same as what we understand. Cash and bank is also same. Prepaid expenses same. Advance tax same. Income tax provision same. Creditors for expenses are same. Creditors for raw material is again important. It is the annual credit purchase, yes. Divided by 12 months, yes. Into average payment period, yes. Now closing minus consumption, closing plus consumption minus opening. As I told you that the closing and opening are same. So we understand that you need not to write the closing as well as opening. Taking into account the consumption, you can compute the creditors. See, the creditors are not calculated based on that is consumption. Creditors are calculated based on the purchase only. But what happens at the opening and closing are same? That is the reason. So the closing itself is consumption. So that the consumption itself is purchased for the purpose of creditors calculation. And so on, we are required to make the computation of the answer for the working capital. Now, listen to my explanation carefully. Suppose there is a change in the activity level. Even in that situation, we'll assume the opening and closing same. You may have a point that, sir, how can we assume like this? Because suppose in the previous year we were producing and selling, let us say 36,000 number of units. This year we are going to produce and sell, let us say 48,000 number of units. If at all we keep the raw material holding period 1 month, then previous year we were keeping the raw material stock of 3,000 number of units. This year event we are going to keep the stock of 4,000 number of units. So this year and the closing stock that we are going to maintain is more than the opening stock. If at all the closing stock is more than the opening stock, then can we say that the purchase is more than the consumption? Yes. Why? Because the closing stock is more. Yet, this kind of effect will be ignored. And taking into account the new activity level, 48,000 number of units will make the calculation. Understand it carefully, dear students, that what happens, assuming that the new activity level at which we are required to compute the working capital for the second year. Suppose the year which has just been completed is 2019-20, in which we were producing 36,000 number of units. In the year 2020-21, we will have 48,000. Now, I agree that say for the year 2020-21, the purchase will be more than consumption. Why? Because the closing stock is more than the opening. However, 2021-22 onwards, what will happen? Opening and closing will be same? Yes. So the CA Institute says that say over the long time period, what will be the requirement of the working capital, that we want to know. We want to compute the working capital for this year and not for this year. So even in this case, assuming that the opening and closing are same, we are required to make the calculation of answer. Same is the case which is applicable for the double shift. We'll assume the opening closing same for the purpose of doing answer. In case of double shift working, friends, what happens that raw material holding period, WIP holding period, finished goods holding period, everything is required to be computed with the single shift first of all. When we move from single shift to double shift, listen carefully, single shift to double shift, raw material holding period will remain same, finished goods holding period will remain same, average collection period will remain same, creditors like the time period will remain same. The only thing which is going to take place is WIP holding period will reduce to half. Okay, so be careful for this important point. When we switch over from single shift to double shift, even in that case the total fixed cost is always going to remain same. The variable cost per unit will remain same. It means that with the increase in the production activity, say our variable cost in total will increase. However, the total fixed cost will remain same. One more thing that I want to tell you is this. Sometimes we are provided with the different credit period. 1 month credit for the domestic sales and 3 months credit for export sales. It has been given that the sale prices in case of export 10% below the domestic price. So importantly, what you are required to do, you are required to convert this into equivalent term. 54 lakhs divided by 90%, so that comes to an amount of 60 lakhs. So 120 lakhs, 60 lakhs. So what is the proportion? It is 2:1 proportion. Whatever the cash cost of the sales that we have, that will be divided into this proportion and then into average collection period divided by 12. Into average collection period divided by 12. That is the way the value of the debtors is calculated. If the question is providing the information, assume 15% margin for contingencies. Simply 15% will be added for the purpose of calculation of the working capital. So over here, what will happen? It is 1 lakh into 15%, that comes to 15,000. So this is 1,15,000 is the working capital requirement. And friends, if at all the language of the question says like this, statement showing the working capital requirement, if the company wants to make a provision for contingencies at the rate of 10% of the net working capital including such provision. If at all importantly the word is used over here, including such provision, then in that case you have to understand like this. Let us say that's the working capital before margin for contingencies. It is 1 lakh. Then first of all, you are required to find the total working capital requirement. It will be computed as 1 lakh divided by 0.9. That comes to 1,11,111. And then margin for contingencies. Margin for contingencies will be 11,111. That is the way we are required to make the computation. So what kind of language of the question is given is important. Next concept is working capital cycle. We understand that the funds of the company which is in form of cash is first of all getting converted into raw material. Then from raw material it is getting converted to WIP. Then from WIP it is getting converted to finished goods. Then from finished goods it is getting converted into debtors. And then once again we receive the cash. The term raw material holding period is indicating that what is the time period for which the funds of the company remain blocked in the raw material. WIP holding period is indicating the production cycle, the time period in which the raw material is getting converted into finished goods. Once you produce a product, your product is remaining in godown for certain time period before it is sold to the customers. Average collection period is indicating the time period for which funds of the company remain blocked in the debtors. Then you receive the cash. This time period is reduced with the creditors. This is what we understand is basically the working capital cycle. As far as the working capital cycle is concerned, that is indicating the approximately the time period for which the funds of the company remain blocked in the business in form of working capital. Suppose the annual expense of the company is 36,50,000. Then assumption is made that the expenses of the company are evenly spread throughout the year. So the daily expenses are rupees 10,000. Suppose this working capital cycle is of 30 days. Then 10,000 into 30, that comes to an amount of rupees 3 lakhs. That is the way we are required to make the computation of the working capital investment that we have. That is, we understand that the working capital cycle is useful to make the computation of the working capital investment that we have made in the business. Then as far as the working capital turnover ratio is concerned, it is very simple, dear students. It is number of days in a year. Suppose it is 360 days in a year and working capital cycle is of 30 days. Then the answer is 12 times. This entire rotation of the working capital is taking place for how many times in a year is what the working capital turnover ratio is indicating. As far as the carrying cost of the working capital is concerned, it is working capital into cost of capital. Whatever the investment which is blocked in the business into cost of capital, product of both of them is considered to be the carrying cost of the working capital. Next is, we will be provided with the question about the working capital investment policy. There are three types of working capital investment policy. It is conservative, moderate and aggressive. In case of working capital investment policy, as far as the working capital is concerned, what will happen? Let us understand it. You are conservative. It means that say you have a fear of losing business. You give more credit to the customers. You keep more safety stock. So the working capital is more. Of course, in that case, the current ratio is going to be more. Of course, in that case, the total asset is going to be more. What will happen? To the extent of the higher investment, you will not be able to generate the incremental income. So what will happen? As far as the return is concerned, return will be less. Exactly opposite to this is aggressive one. In case of aggressive, what will happen? Your working capital investment is going to be less. Why? Because you are very much like going optimistically. Let's say you will be able to get the business easily. So you give very tight credit period to the customers. You do not keep too much safety stock. So current ratio is going to be less. Total asset is going to be less. And you will be able to generate the higher return. At the same time, so there is one more thing which is required to be considered is risk. Your return is less and at the same time risk is less in case of conservative. In case of aggressive, your return is more and along with that the risk is also more. In case of moderate, what will happen? Everything will remain in between. Everything will remain in between. That is what we will have. This is what's the working capital investment policy. The next is the financing policy. As far as the financing policy is concerned, it is about the raising the short-term and the long-term financing for the purpose of financing the requirement of the funds. Again, in that we have conservative, moderate and aggressive. What will happen? Short-term and long-term. In case of conservative, the long-term proportion will be more and short-term proportion will be less. In case of aggressive, the short-term proportion is going to be more and the long-term proportion is going to be less. What will happen? In case of conservative, your interest cost is going to be more. That is the reason, say, your current that is the reason your return is going to be less. You can see that, say, you will be having, say, the lower amount of the short-term financing. So working capital is going to be more. Your current ratio is also going to be more. In that case, so your risk is going to be less. Why? Because you will not face any problem of the liquidity. You will not face the problem of insolvency. You will be able to make the payments as and when due. While over here, in case of aggressive, the interest expense is going to be less. Why? Because the short-term financing is having lower cost. Return will be more, working capital less, current ratio less, and importantly the risk is more. Over here, again everything will remain in between. That is a financing policy. Next is the maximum permissible bank finance. As per Tandon Committee norm, the maximum permissible bank finance, for that set of 3 methods have been recommended. The first method is a method in which maximum permissible bank, that is bank finance, is 75% of the simple working capital. Current assets minus current liabilities is working capital. Of that, 75% is the maximum bank financing. In current liability calculation at this point of time, the bank loan, existing bank loan will not be considered. Second is 75% of the current assets minus current liabilities. The third is, let's say from the current assets, core current assets will be deducted. Whatever the remaining current assets that we have, again of that 75% will be calculated minus current liability. This is the way we'll have the maximum permissible bank finance as per Tandon Committee norm. Next, theory questions. Enumerate the various forms of the bank credit in financing the working capital of a business. Determine the liquidity versus profitability issue in management of the working capital. You keep more liquidity, profitability is sacrificed, and vice versa. If you keep more liquidity, the profit is less, but the risk is also less. You keep less liquidity, profit increases, but along with that, the risk also increases. Discuss the estimation of the working capital need based on the operating cycle, working capital cycle, or cash cycle. Discuss risk return consideration in financing the current assets. Financing stands for, that's the long-term financing and short-term financing. Your risk will be less if at all you go for more for the long-term financing and vice versa. Discuss the factors to be taken into consideration while determining the requirement of the working capital. What are the sources of the short-term financial requirement of the company? Short-term financial requirement. Operating cycle or cash cycle, that is what we are required to explain over here. So these are the theory questions which are very much connected with the practical questions which have been asked in examination. The next chapter that we are going to revise is treasury and cash management. Let us see the topics that we have, the concept that we have from examination point of view. The first is the preparation of the cash budget. Next is the Baumol's model, Miller-Orr model. The concept of the float, billing float, postage float, internal control processing float, and bank processing float. These are all float period concept. Then connected to that we have the concept of the lockbox system and concentration banking. In November 1910 marks question was there from the preparation of the cash budget. So on an average it is 2.25 marks. Dear students, as far as the cash budget is concerned, cash budget is indicating budgeting, forecasting, estimating the cash received and cash payment. Basically, it is prepared as a part of the short-term planning. It is prepared with an objective to forecast that do we have any shortfall in any of the month. Suppose we are preparing the cash budget starting from January to June. In the month of March, we have we can see that there is a shortfall. The closing balance is negative. Forecasted closing balance for the month of March is negative. Then we understand that in the month of March, whatever the opening balance that we have, whatever the receipt that we have, they are not sufficient to make the payments which are becoming due in the month of March. That is the reason so this closing balance is negative. Before that month comes, we try to make some arrangement of the funds internally if possible. Wherein if at all we can postpone any of the payment, we would like to postpone it. If at all any of the payment that is received can be preponed, we'll try to prepone it. That is the way we'll try to make arrangement of the funds. If such kind of arrangement is not possible, then in that case we are going to borrow funds. In case of borrowing, if at all we have a good time, then in that case we can get a good deal. We will be able to bargain for the lower rate of interest. That is the way we will have the advantage of borrowing at the lesser rate of interest. This is what we understand is the arrangement that we have in the cash budget. This is the first thing. Understand it importantly, friends, that cash budget is prepared by taking into account all the transactions which are affecting cash. We do not have any bifurcation of the transaction in form of revenue, in form of capital, such kind of, the bifurcation is not made, and we prepare the cash budget. We understand importantly that in preparation of the cash budget, any transaction which is affecting cash would be considered. Of course, non-cash item like depreciation will not be considered in preparation of the cash budget. If at all there is an excess closing cash balance every month, then we require. Suppose we need approximately 50,000 to 1 lakh rupee in the business. However, the projected closing balance is 5 lakhs, 7 lakhs, 10 lakhs, something like this. Then that excess amount can be invested in order to generate some amount of income for us. That excess amount can be used for making prompt payment to the supplier, and we can get the advantage of the discount. That is the way this excess amount of the funds can be used for the purpose of generating this kind of income. Next thing that we understand is this, that for preparation of the cash budget, as such there is no format which is required to be followed. It is going to be prepared in a simple tabular format, opening, receipt, minus payments. That is the way like we'll make the computation of the closing balances at the end of every month. So simple that format is required to be followed. Further, there is no special sequence in which you are required to make the computation of answer. Usually, the working notes are required to be prepared if at all any of the information which is missing. For example, we have been given sales, we have been provided with the GP ratio, then information is provided about the stock. Then purchase will be computed as a balancing figure, and for that we may have to prepare the working note. Next thing is that maybe any of the receipt or any of the payment is split over more than 1 month. Suppose it has been given that the credit sales are collected like 70%, 20% and 10 months, like that information is given. So if at all it is going to be received split or it is going to be paid split, then preferably for that also we prepare the working note. Otherwise, working notes are not required to be prepared, for everything. And we can incorporate everything, into a table for the purpose of preparation of the cash budget. This is what we understand. Now, there are certain special things that I want to tell you. The first thing is that we may be provided that apart from preparation of the cash budget, you prepare the forecasted income statement. You are required to do the projected, the balance sheet. Then when we are doing the balance sheet, when we are doing the income statement, then in that case we are required to follow the accounting rules and regulations. As far as the accounting rules and regulations is concerned, in that any of the expenses which is due will also be taken into account for preparation of the income statement. Depreciation will also be considered as that is even though it is a non-cash item, because as far as the accounts is concerned, accounts does not differentiate this kind of the information. So that is the way we have to consider it. Importantly, the language of the question is very important over here. let's say when you are required to consider the receipt, when you are required to consider the payment is important. Now dear students, connected to that, so there is a concept that is called clear funds forecast. There is a very good question of the module in which the question says that you are required to make the computation of the clear funds forecast. Now the word clear funds forecast means you are required to prepare from passbook point of view what is the closing balance that you have at the end of every day. You are provided with the date on which the transaction is taking place and the date on which its effect will be there in the bank statement or in passbook. So whatever this kind of information is provided to us will be considered importantly in detail for preparation of the clear funds forecast. Like X limited check will be paid in Prachi Limited's bank account on the same day as the sale is made. Means the date of deposit is provided to us. And will clear on the third day following this, excluding the date of post, that is the date of payment. Means excluding the date of deposit, it will clear on the third day. So third day to that, we are supposed to consider the same as a receipt for preparation of the clear funds forecast. This is an exceptional question of the study material. At the same time, it is an excellent question that we have. The question says that over here, show clearly, that is prepare a clear funds forecast for the period 7th of January to 11th of January 2020. This is the first question. And then the second part of the question, show clearly the uncleared fund float each day. Now what does it mean? It means that you are required to make the computation of the bank reconciliation statement. This is what's again an excellent question that we have, in which we are required to prepare the BRS. These questions have like so different language that so the interpretation of the same becomes sometimes difficult for student. This is again a module question. From the following information relating to a departmental stores, you are required to prepare 3 months ending March 20 month-wise cash budget. Now friends, over here directly the transactions are not that is provided to us. We have been provided with the closing balances. So what happens that we have to understand that the short-term investment reduces, so there must be sale of investment. Short-term investment increases, so there must be purchase of investment. Then the data that we are required to understand along with the sales information. Let's say what must be the collection during the month. Then the stock that we have to understand along with the cost of sales to compute the purchase. Once you have purchase, then using the trade creditors will make the computation of the payment to the creditors. See, dear students, what I want to tell you is that you have to understand importantly that what sort of information is provided to us over here that you need to understand. See, preparation of the cash budget is very simple, but sometimes understanding of this information becomes difficult for a student. Next is the Baumol's model. Dear students, as far as the Baumol's model of the cash management is concerned, it is exactly the same as the EOQ with no change. Over here we compute that what is the optimum transfer size of the funds, so that we can transfer the funds say from the liquid securities account to the current account. So over here the formula is similar to the EOQ formula, 2 into A into O, that is cost per transfer divided by rate of interest and under root of the same. That is the economic lot size, or we can say that it is the optimum transfer size of the funds. This is the transfer size of the funds at which the total cost is going to be the lowest. At this point of time, the total carrying cost itself is the total transfer cost. As far as the total carrying cost is concerned, it is calculated as transfer size divided by 2 into rate of interest. That is the way it is calculated. and total transfer cost is calculated as A, that is the annual requirement of the funds, divided by transfer size. So that will give us the number of transfers in a year, multiplying with the cost per transfer, that is into O. That is the way the total transfer cost is calculated. So this is the formula which is required to be applied. We understand that for the different transfer size, the total cost is going to change, and we want to know that such transfer size at which the total cost is going to be the lowest. Then we have the Miller-Orr model. As far as the Miller-Orr model is concerned, it is again a cash management theory, which says that there are three types of cash balance limit that we have to determine. One is upper limit, second is a return point, and the third is lower limit. Upper limit, return point, and lower limit. Keep the cash balance anywhere between the upper limit and lower limit, and you start implementing this cash management theory. So daily what will happen? The cash balance will change like this. There will be a point at which the cash balance may increase to the upper limit. When it increases to the upper limit, at that point of time, you should make investment of the excess funds in the liquid securities, so that the balance reduces from the upper limit to the return point. Again, you keep on doing the business. Your cash balance may reduce to the lower limit. If it reduces to the lower limit, then in that case, make redemption of the funds. Such amount of the funds will be redeemed from the liquid securities, so that the balance increases from the lower limit to the return point. And with that, again, you continue with the business. If at all the balance is between the lower limit and the upper limit, then in that case, no transaction is required to be entered upon for redemption or for the purpose of investment. That is what the theory says. So this is what we understand is a Miller-Orr model. Miller-Orr model does not give, any numericals. That is, as far as the syllabus is concerned, in that the new numericals is included. Otherwise, the theory itself is having, an explanation how this upper limit, lower limit is required and return point is required to be calculated. Next that we have is the concept which is given a name as the float period. The term float period stands for time gap. As far as the float period is concerned, it is divided into two parts. One is received float and another is the payment float. Dear students, for the time being, let us have a focus on the received float. Received float means that as a company, I am supposed to receive my payment, and there is a delay in receiving my payment. That is what we understand is a received float. Received float is divided into certain parts like this. One is given a name as the billing float. Second is given a name as the postage float. Third is given a name as internal control processing float. And fourth is given a name as the bank processing float. There are four types of float period. The term billing float stands for that there is a delay in invoicing. Billing float is indicating that there is a delay in invoicing. Suppose you have sold goods to the customer on 1st of April. However, the invoice was sent to the customer on 5th of April. So this time gap is considered to be the billing float. Billing float means that there is a delay in invoicing. Next is postage float. That is indicating that when the customer is sending the payment to you, at that time, in post, that is in the time in which the courier is sent, that is is received by you, that is postage float. Suppose the credit period is 3 months. So after 3 months, on 5th of July, your customer is sending payment to you from outstation. Let us say that your customer is out, that is says from outstation, and your customer is sending a payment to you via post, and the check is received by you on 7th of July. So this time period is considered to be the postage float. Once you receive the check, afterwards you deposit the check. In depositing of the check, say again there is a time gap. Let us say that once you receive the check, after that you process the check to make sure that it is properly recorded in your books of accounts, in your records before it is deposited. So actually the check is deposited on 9th of July. So this is considered to be the internal control processing float. Once you deposit the check, it is getting clear in a certain number of days. Whatever the number of days that it takes, say for the purpose of clearing, that is given a technical name as the bank processing float. Because it will take some time, say for the clearing system. So that is bank processing float. And actually on 12th of July, let us say the amount is credited to your account. This is what we understand is a different kind of float period that we have. And technically it is given a name as a receipt float. Okay. Now once this receipt float concept is done, we have to understand the solution of this receipt float. There are two solutions that we have. One is given a name as lockbox system and another is given a name as the concentration banking. How these two systems work, that is now what we are going to discuss. First of all, discussing the lockbox system. Now as far as the lockbox system is concerned, it is indicating that a system in which the company will try to reduce the receipt float by having a kind of arrangement with the post office and with its own bank. What will happen over here? The company will first of all search for the post office which is near to its majority of the customers. Suppose the company is having the head office at Bombay and it is having its majority of the business in Delhi. So what it can do, the company which is there in Bombay can have its own arrangement of the lockbox system in which it will look for a post office which is near to its majority of the customers. Customers will be instructed that on the due date, you send the payment at the lockbox which is there in the post office. Post office is giving a facility in which you can hire a box at the post office. So that the post office box will be given a specific number. So the company will invoice its customer along with that post office box number details and telling to the customer that on the due date, instead of sending the payment to us, you send the payment at that post office lockbox. So what will happen, dear students, as far as the postage float is concerned, this postage float will be reduced in that case. Next, what will happen? The post office lockbox is having a number of checks now. Now the company will have it's an arrangement with the bank. Let us say that the company is having its bank account with ICICI Bank. So what the company will do, the company will tell to ICICI Bank that you go at this post office and you collect the checks which are lying over there. Whatever the checks which are lying over there, you collect it, a list of the check you send it to us, only list of the checks, and send all these checks for the purpose of clearing. So what will happen, dear students? We understand that the internal control processing float will be eliminated. Because what bank is required to do? Bank is just required to collect the checks. A list will be prepared that the ABC customer check amount is 5,000. BCD customer, check amount is 8,000. XYZ customer, check amount is 20,000. That is the way the only list is required to be prepared. The bank is not required to cross-verify, or bank is not required to make sure that this transaction is properly recorded before the check is deposited. So as far as the internal control processing float is concerned, it will be entirely eliminated. We understand further like this. Listen to me carefully. What will happen? Over here the arrangement will be made in which say the entire, that is say the check is say the process from there only. So now what happens at say the when the list of the check is received by the company, then from this list we will be doing our internal control system. It means that say, let us say for example, from ABC Limited we have received the check of 19,600 and actually the bill amount is 20,000. Then why this 400 rupees is deducted by them? For that say we will have a conversation later on with them. With individual customer, say we will be having say any conversation about the dispute later on. And whatever the payments that say we have received, so that will be properly recorded in our books of accounts, and with that the internal control system will be followed. Okay. Now those checks are sent for the clearing, say over there, that is in Delhi only. So what happens at say ultimately all those checks are going for the local clearing instead of outstation clearing. That is the reason as far as the bank processing float is concerned, it is also reduced. That is the way you get the advantage of reducing the overall float period. Reduction of the overall float period will give you the savings of the carrying cost. Whatever the savings of the carrying cost that you have, that you are required to compare with so the cost of implementing lockbox system. If at all the savings is more, then in that case you should implement the lockbox system, not otherwise. Because we understand that at the post office you are required to make payment of the charges. Further, you are required to make the payment of the charges set to the bank who will provide all these services to you. This is what we understand is the method by which the lockbox system works. Next, there is another system which is given a name as a concentration banking. Let us have understanding that in case of concentration banking, what will happen? Over here, again, say the company will have, that is a company which is there, its office in Mumbai, so will have its own collection centers strategically located, say at the different places. The company will have its own collection centers, say at the different places in such a way, so that it will be able to get the collection from the customers easily. The collection centers will be established on the private basis and they will be authorized to collect the payment on behalf of the company. Even the customers will be instructed that say instead of sending the payment to us, you send the payment at the collection center. So the company having its head office in Mumbai will have the collection centers at the different places. So what will happen? Let's say the customers in those area will be instructed that these are the collection centers that we have established. So instead of sending the payment to us, you send the payment directly at the collection center. Again, the collection center will prepare a list of the checks which are deposited on our behalf to the, that is in the bank, and that list will be sent to the company. From that list, so the company will be preparing, that is the company will be completing the internal control process. This is the way the entire concentration banking system will work. Okay. Again, we understand that over here we are required to make a comparison of the savings in the carrying cost with the cost of implementing the lockbox system. If the savings is more, then in that case we should implement the lockbox system, not otherwise. Let us have a look of the theory questions which have been asked from this chapter. It was asked that say, write a short note on William J. Baumol's versus Miller-Orr model of the cash management. What are the forms of the bank credit? State the advantages of the electronic cash management system. Electronic cash management system means, let's say you go for the virtual banking instead of offline banking. What is virtual banking? State its advantages. So almost the same. Management of the marketable security is an integral part of the investment in cash. Comment. Explain the concentration banking and lockbox system. Explain 4 kinds of the float with reference to the management of the cash. Billing float, postage float, internal control processing float, and bank processing float. Again, a question is Miller-Orr model of the cash management. Evaluate the role of the cash budget in effective cash management system. That is, what is the significance of the cash budget? Explain briefly the functions of the Treasury Department. Again, explain the concentration banking and lockbox. So 2 times this question is asked. Describe the principles guiding selection of the marketable securities. That is safety, marketability, liquidity, and so on. Like that, so these are the questions which have been asked from this chapter in examination for theory. Next is the chapter management of the inventory, that we skip because it is entirely covered in the costing. Next is the management of the receivable, that is the chapter with which we are going to start with the discussion. The concepts which have been included over here, so in this chapter, are like this. The first is explanation about the carrying cost. Next is determination of the credit period to be offered to the customers, and from this segment there was a question of 10 marks asked in November 2018. Next is the cash discount to be offered to the customers, then determination of the collection policy, calculation of the carrying cost of the additional working capital, carrying cost if the tax rate information is given to us, and the decision making. Information about only incremental sales have been given. So we can say that, say, there was only one time asked in examination, 10 marks. However, this is of course important because whenever it will be asked, it will be either a 5 marks or 10 marks, and the chances of 10 marks are relatively more. Let us have a discussion about the different concepts that we are going to discuss over here in this chapter. Basically, we understand, friends, that whatever the credit period which you are offering to the customers right now, that credit period, suppose right now you are offering the credit period of 2 months to the customers, and whatever the sales that you have, let us say that you have sales of rupees 10 lakhs and you have a profit right now of rupees 2 lakhs. If at all you increase the credit period, let us say from 2 months to 3 months, then the sales is bound to increase. From 2 months to 1 month, then the sales is bound to reduce. So the sales of the company is, say, going in the same direction as the credit period. However, the profit of the company may not change in the same direction every time. It may happen that, say, the sales of the company increases. Even in that case, so the profit of the company is reducing instead of increasing. When sales reduces, usually profit reduces. However, it may happen that the profit may increase. That is the reason it is necessary, it is essential for a company to decide that, say, what credit period we should offer to the customers. And for this decision making, we learn, say, this chapter that is called, say, the receivable management. The first thing that, say, we usually understand over here is that explanation about the carrying cost. Dear students, the term carrying cost means that whatever the credit period that we offer to the customers, to that extent, the funds of the company remain blocked in the business. So whatever the funds of the company which remain blocked in the business, that has always an opportunity cost. That amount can be invested somewhere else. And investing this amount somewhere else, we could earn some amount of the return. And whatever the amount of the return that say we can earn otherwise, that is considered to be the carrying cost, and that is the minimum profit that you desire from the business. Whenever you are doing business, then in that case, let us say, for example, 10 lakh rupees of the funds is blocked in the business. This amount of the funds, say, can be invested somewhere else, let us say at the rate of 16%. So whatever the profit of rupees 1,60,000 that you can earn otherwise, that amount is minimum to be recovered from this project or from this business. That is considered to be the carrying cost. Carrying cost is calculated as like by applying a simple formula like this. It is the total cost divided by number of days or number of months in a year. Let us say it is 12 months multiplied with average collection period. Importantly, friends, this equation is indicating that what is the amount of the investment that you have to make in the business multiplied with the cost of capital. So that is the way we make the computation of the amount of investment. First of all, this is the investment multiplied with the cost of capital. That is the way, so we make the computation of the carrying cost. This is what we understand. Now, for the purpose of decision making, we have certain techniques like this. We can say that the first thing is, what we can apply is the total profit or loss approach for decision making. The first is the decision making by using the total profit or loss approach. The second is the incremental approach that we can adopt for the purpose of decision making. Third is, we have the total relevant cost approach. That is the way we have, say, these three popular approaches for the purpose of decision making. As far as the incremental approach is concerned, friends, incremental approach can be adopted for any of the question. Any question, we can always adopt the incremental approach for decision making. As far as the total profit or loss approach is concerned, that can be adopted only if we have been provided with the information about the existing sales, new sales. These two information have been given to us, and along with that we have been provided with the information, say, about the variable cost or total cost. This information is required for the purpose of adopting the first approach, that is total profit or loss approach. Total relevant cost approach can be adopted only if the sales value remains same. Only in that case we can adopt the total relevant cost approach for decision making. So at the start of the question, you have to see that, say, whether you have been provided with any of the specific method to be adopted for decision making. If yes, then in that case you have to follow that method. Of course, if at all you have been provided with any specific method for the purpose of decision making, then that method must be appropriate. That method must be possible in the given question. So first you have to see that whether any method is given or not. If no specification is made, then in that case you have to see that, say, based on the information given, which one of the three methods or two of the three methods, or whether we can apply all the three methods. If yes, then in that case one of the appropriate method according to you will be adopted for the purpose of decision making. This is the way we are required to make the computation of the answer. In case of total profit or loss approach, generally I suggest students to do answer like this. The first thing is, let's say you make the computation of the total fixed cost. I suggest to make the computation of the total fixed cost. Why? Because the total fixed cost is going to remain same for each of the credit period. That is the reason step number 1 is the total fixed cost. Second step is variable cost to sales ratio. Now dear students, what happens at say whenever there is a change in the sales value may be increasing, may be decreasing. In both the cases, what will happen? The total variable cost is going to change. So in what proportion it changes, to compute the same, we make the computation of the variable cost to sales ratio. That is our step number 2. Third step is total profit or loss for each credit period. So for each credit period, we'll make the computation of the profit or loss. And the credit period at which we have the maximum profit, that credit period we will recommend, the company to suggest, that is said to offer to the customers. That is what we will do. That is the present and proposed. There may be number of proposals that we will be provided. Sales, variable cost, fixed cost, carrying cost, bad debts, if at all bad debts information provided to us, collection cost. Dear students, as far as the collection cost is concerned, it means whatever the cost that we incur for the purpose of collecting the receivable is collection cost. That includes the payment that we make to some staff members who may be appointed to collect the receivable on behalf of the company. Second thing that we understand is we may have appointed certain staff members who will do regular messaging or some other infrastructure expenses that we have for the purpose of doing follow-up to the customers for the purpose of getting collection. The next thing that we understand is that we may have to incur certain expenses in terms of the fees of the lawyer in order to sue our customer for the recovery of the money. All those expenses are considered to be the collection cost. Then we may be provided with the information about the cash discount. Whatever these expenses that we have will be deducted from the revenue, and based on that we'll make the computation of profit or loss. The option which is having the highest profit will be selected. So the present profit or loss will be calculated and the proposed profit or loss will be calculated. The option which is having the highest profit, that option will be suggested that we will propose to the customers for the purpose of giving credit, and with that we will be able to make the maximum profit. This is what we understand. As far as the carrying cost is concerned, that is the minimum profit that we desire, so it is deducted in computation of the profit or loss. So in case there is a loss, it means that it is not viable to do this business. It is better that we invest the funds somewhere else. Directly we will be able to reach to the conclusion, we will be able to reach to the decision once we deduct the carrying cost in computation of the profit or loss. This is what we understand. The next is method number 2 that we have is incremental approach. Method number 2 that we have is incremental approach for the purpose of decision making. In case of incremental approach, what happens? In step number 1, we compute again the total fixed cost. Step number 2, again we compute the variable cost to sales ratio. In step number 3, what happens that we make the computation that when we offer the new credit period over the existing one. When we offer the new credit period over the existing one, what is the change? What is the difference in the carrying cost? That is what we understand is the calculation of differential carrying cost. So what happens that say we make the computation of the carrying cost present. Proposal 1, proposal 2, proposal 3. Suppose there are 3 proposals. Present carrying cost is 10,000. Proposal 1 is 12,000. Proposal 2 is 16,000. And proposal 3, it is 19,000, for example. It is like this. Then in that case, what will happen? The incremental carrying cost is 2,000. That is proposal 1 over the existing. Then incremental carrying cost is 6,000. Proposal 2 over existing. Then the proposal 3 incremental carrying cost or the differential carrying cost is 9,000. In a way that it increases to 19 from 10,000. That is the way the differential carrying cost is calculated. Step number 4, calculation of incremental profit or loss. Okay, in incremental profit or loss, how do we make calculation? Let us see. Proposal 1 over existing, 2 over existing, 3 over existing. We mentioned the sales. 1 over existing, 2 over existing, 3 over existing. That is the way we'll mention the sales. Importantly, friends, we are required to mention over here incremental or the differential one. This is what we are required to compute. Then variable cost, again the incremental one. So whatever the increase in the sales into variable cost to sales ratio. Usually fixed cost will be 0, that is in terms of incremental fixed cost. Because the new fixed cost is same as the existing one. So the fixed cost will be 0. The next one we will have the carrying cost. That is again new over existing. New over existing. That is the way we'll make the computation of the incremental carrying cost. Then incremental bad debts that may be provided to us. Incremental cash discount that may be provided to us. Incremental, so the collection cost, that kind of information may be given. Like that, say all the differences value we will write to compute the incremental profit or loss. For first option, for second option, for third option. If at all the options are having profit, we'll select the highest profit. That is a combination of the profit or loss, we'll go for the profit. If at all the options are having a loss, we'll go for the existing one. We'll advise the company that say you continue with the existing one. That is the way we are required to write the answer. So this is the way we'll make the computation of the profit or loss, and the decision will be taken, say, about the credit period to be offered to the customers. Now friends, there are certain special points that I want to deal with you. We may be provided with the information like this. That say what is the present situation and what is the proposed situation. In proposed situation, we may be provided with information that there is an increase in working capital in proposed policy, let us say by an amount of rupees 1 lakh. So when we are making the computation of the profit or loss, then in that case, importantly, we are required to consider the carrying cost for additional working capital, which we are required to invest, say, with the new policy. That will be calculated as working capital amount multiplied with cost of capital. Let us say it is 20%. Then in that case, it comes to 20,000. So this is important. You have to make sure that say your new credit policy should be able to recover that carrying cost, that opportunity cost. 1 lakh rupee of the investment that say we have made in the business is not our cost. However, this amount could be invested somewhere else, and whatever the income that say you could have generated is your opportunity cost, and that opportunity cost you need to recover from the new policy. This is the way we are required to consider the effect of this incremental working capital, and remember that this additional investment is required to be made in the business forever. it is not only for a certain time period we are required to make the investment, we are required to make the investment of this additional investment forever. Accordingly, its annualized carrying cost should be recovered from the business. Now friends, we may be provided with the information about the income tax. Whenever the income tax information is provided to us, in that case, always remember that to a certain point of time, the calculation is always going to remain same. Like sales minus variable cost, minus fixed cost, minus bad debts, minus cash discount, minus collection cost. All these things are always going to remain same. Then we have the profit before taxes. Then we have the income tax. And then we have the profit after taxes. Now the important thing is to deduct the carrying cost. Now as far as the calculation of the carrying cost is concerned, it is going to be same. Total cost divided by 12 months into average collection period into cost of capital. Say the formula is like this only. And whatever the answer that we compute, let us say that the carrying cost comes to rupees 20,000. This amount is also going to remain same every time, whether the tax information is given or not. Now the important point is that you have to see that this cost of capital is provided to us as before tax or after tax. This cost of capital is given to us as before tax or after tax. If at all the cost of capital is given to us as before tax, then in that case, before you calculate income tax, carrying cost will be deducted. Carrying cost will be deducted before computation of income tax. And suppose the question is providing that the cost of capital is after tax, then in that case, from profit after taxes, the carrying cost will be deducted. So when to deduct carrying cost is important. How to compute is not important, because the computation of the carrying cost is as simple as what we do. But when to deduct it, that depends upon that the cost of capital is given pre-tax or post-tax. If it is given pre-tax, then in that case, before you compute the income tax amount, you are required to deduct it. If it is post-tax, then after computing the income tax, you are required to deduct the carrying cost from profit after taxes. Now friends, there are certain questions in which we are provided with the information about only incremental sales. We are provided with the information about only incremental sales. And with that, we are required to take the decision. That is, there is a group of the customers to whom we are considering to sell goods. If at all we sell goods to that customers group, then the sales will increase by an amount of 10 lakhs and so on information have been given. Whenever you come across this kind of situation, then remember that only incremental approach is possible for decision making. Why? Because the existing sales have not been given, so we cannot go with the step, that is option number 1. Second thing that we understand is that the information about the increase in the sales is given to us. It means that the existing sales and the new sales are not same, so the third method cannot be applied. So we are only left with the second one. So this is an important point for which you should take care. Next is, for the purpose of carrying cost calculation, we will be provided with one of the following information. Total cost, then in that case the carrying cost will be calculated on total cost. Then we have been provided with the information about only variable cost. Total cost not given. Then in that case we are required to compute the carrying cost on variable cost. Over here, total cost and variable cost have been given. Even in that case, we have to compute the total cost. Total cost is not given, but variable cost is given. Then in that case, on the variable cost. Then neither variable cost nor total cost given. then in that case we are required to make the computation of the carrying cost on sales value. Okay, so just be careful that based on the information on which value you are required to make the computation of the carrying cost. One more thing, friends, as I told you that say it may happen that we are provided with information that say the sales value is same for all the options. Then in that case, usually the question is about the decision making about the collection policy. What will happen? We will be provided with the present, proposal 1, proposal 2. That information have been given. In that case, we will be provided with the information, say about, let us say, bad debts, average collection period, which will be useful for calculation of the carrying cost. Then the collection cost information provided to us. Maybe the cash discount information is given to us and so on. Then in that case, if at all the sales value is same in all the options, then cost of the bad debts, then carrying cost, because average collection period will be useful to compute the carrying cost. Collection cost, cash discount, like that, so we make the computation of the cost for the individual component and will make the computation of the total cost for present, for proposal 1 and for proposal 2. For each of them will make the computation of the total cost. The option which is having the lowest cost will be selected. Because what happens at say overall sales value is same? Yes. So overall variable cost is also going to be same? Yes. Fixed cost is always going to remain same? Yes. So what happens at say only these expenses keep on changing. So you make the total cost calculation for each of them, and the option which is having say the lowest cost will be selected. Dear students, sometimes information is provided to us about the data's turnover ratio. Now the information about the data's turnover ratio is provided to us for the purpose of making calculation of average collection period. So we have to understand and say how that information is useful for the purpose of decision making. Now there is a question that I want to discuss. As a part of the strategy to increase sales and the profit, sales manager of a company proposes to sell goods to a group of new customers with 10% risk of non-payment. This group would require 1.5 months credit and is likely to increase sales by 1 lakh rupee per annum. Production and selling expenses 80% of the sales, and income tax rate is 40%. The company's minimum required rate of return on after-tax basis is 25%. Should the sales manager proposal be accepted? So over here we are required to decide in the first part of the question that whether we should sell goods to that customer or not. We can see that only information about the increase in the sales is given. So sales minus production expenses minus bad debts, PBT minus tax is PAT, and from that the carrying cost will be deducted. Second part of the question, also find the degree of risk of non-payment that the company should be willing to assume if the required rate of return were 30%. So in second part of the question says that you are required to compute that what are the chances of bad debts that you can afford so that you can get a return of 30%. I want to tell you something like this. That's a number of times for these kind of questions, students are not able to understand the question. That over here in this question, you don't have to compute the profit. You're required to compute the chances of bad debts at which, say, you will be able to get a return of 30%. So be careful in reading and interpreting this kind of questions. One more thing that I want to tell you is that number of times we are provided with information that the customer does not make the payment of the bill at a stretch. It is given that say the customer is making payment of the 15% of the bill after 30 days, 84% of the bill after 100 days, and for 1% of the bill there is non-recovery. So whenever this kind of scattered payment is provided to us, then we have to compute the weighted average collection period, which will be useful for calculation of the carrying cost. Like over here, 15% of the bill is received after 30 days. 84% of the bill is received after 100 days. And for 1% of the bill, there is non-recovery. So 88.5 number of days will be taken for the purpose of calculation of the carrying cost. Now, theory questions. 2 questions are there so far. Explain briefly the accounts receivable system. Over here, we are required to give emphasis on the computerization instead of manual system that is keep for the purpose of keeping the records with respect to the collection. Explain aging schedule in the context of monitoring receivable. Aging schedule stands for that say what is the time overdue. Overdue by 30 days, that is within 30 days, overdue within 60 days, overdue within 90 days. So if at all the overdue increases, then in that case the management can have a control over the collection by looking to this kind of reports. Next is management of the payables. In case of management of the payables, let us refer the scanner first of all. Dear students, what I have done is in payable management, there is actually only one concept in the module, decision about the cash discount. However, I have included over here the factoring without loan information and factoring with loan information. So the concept of the factoring I have included over here, say in this segment of the payable management. Further, you can see that say, yet any question has not been asked from this segment. Dear students, I believe that, of course, no question has been asked from this segment. However, if at all the question is there from the cash discount segment, that is in the payable management, the decision making about the cash discount, then in that case, it may carry the marks weightage up to 5 marks maximum. However, if at all the question is there from the factoring segment, then in that case, it will definitely carry the 10 marks weightage. That is what's the kind of importance I can tell you with an assurance from examination point of view. Let us discuss one by one concept. The first is the decision making with respect to the cash discount. Over here, friends, we will be provided with some information based on which we are required to decide that whether to avail the cash discount advantage or not. So a kind of credit term that we understand is like this. Let us say 3 by 10 net 80. It means that say we are offered with credit period of 80 days. However, if at all we make payment within 10 days, then in that case we can get cash discount at the rate of 3%. This is what the 3 by 10 net 80 is indicating. We understand further like this. I is equal to PRN upon 100. 3% is the rate of discount. So 3 rupees is the interest. Principal is 100 minus 3 into R upon 100 into time period is 80 minus 10 divided by 365. Because we are required to make payment only by how many days? 7 days. By making payment of rupees 97 only by 70 days, you get cash discount advantage of rupees 3. So whatever the advantage that you are going to get is converted into annualized term. So in that case, the advantage to which R variable is assigned is 3 upon 97 into 365 divided by 70 into 100. So technically you have advantage of rupees 3 for making payment of rupees 97 into 365 divided by 70. You convert that into annualized term. Multiply with 100 for getting answer in percentage term. This is the way we are required to make the calculation of the advantage that we have of availing the cash discount. Whatever the advantage that you have of availing cash discount will be compared with the cost of capital. If at all the advantage that you have is exceeding the cost of capital, then in that case you should avail the cash discount. If at all your advantage is less than the cost of capital, then in that case you should not avail the cash discount. If both of them are same, then in that case you are indifferent whether to avail the cash discount or not. This is the way we are supposed to take the decision. Let us have a discussion of the question of module. The Dolce company purchases raw material on the terms of 2/10 net 30. So we buy the raw material based on these terms. A review of the records by owner Mr. Gupta revealed that the payments are usually made 15 days after the purchases are received. So usually we make payment after 15 days. When asked why the firm did not take the advantage of the discount, the accountant Mr. Ram replied that it cost only 2% for these funds, whereas a bank loan would cost the company 12%. So there is an advantage of only 2% of getting the cash discount. However, as against that, the loan rate of interest is 12%, so we do not take the advantage of the discount. What mistake is Ram making? So we are required to identify over here the mistake as that 12% is of the entire year and 2% is the advantage that you get, say, when you make early payment by a few number of days. So both of them are not directly comparable. That is the first thing. Second thing that we understand is that information is given that say we make the payment after 15 days. It is after 10 days, so we do not get the cash discount. However, there is no need of making early payment that is earlier than 30th day. Because when you make payment after 10 days, you have to make the payment of the full invoice amount. If at all you have to make the payment of the full invoice amount, then in that case you do not get advantage of the cash discount. Then why to make the payment early? We should delay the payment up to 30th day so far possible. That is a mistake. What is the real cost of not taking the advantage of the discount? So whatever the discount advantage that say we could have received, we are not receiving. What is cost of the same? So I is equal to PRN upon 100. Interest is rupees 2. Principal is rupees 98. R is required to be found as balancing figure. And right now we are making payment on 15th day. If at all we make payment on 10th day, you can get the advantage. So R will be calculated as balancing figure. Next, if the firm could not borrow from the bank and was forced to resort to the use of the trade credit funds, what suggestion might be made to RAM that would reduce the annual interest cost? Dear students, what happens at say I have seen that number of times students are not able to even understand this kind of question. Yes, they are not even able to understand that say what is the question. If at all they do not understand the question, then of course they cannot give answer also. Over here the question says that say if at all the company cannot borrow, means the information of the 12% is withdrawn, and was forced to resort to use of the trade credit funds. It means that say the company does not have any option but to use the funds which is received out of the business cash accrual for the purpose of making payment to the supplier. We can see that say out of the business cash accrual, we are able to make the arrangement of the funds in 15 days. Now, earliest you can make the payment on 15th day. And so the 30 days is the time period for which the credit is available to you. So you should delay the payment up to 30th day and you should make investment of the funds say for 15, that is the remaining 15 days. That is what you should do. This is what's the answer that we are required to give. What happens at say understanding of the question is important, only in that case you can give answer. Now after this, let us have understanding of the concept of the factoring. Because for cash discount only these 1 or 2 important questions we have. Dear students, as far as the factoring is concerned, factoring is like a professional agency which is appointed for the purpose of say the collection work. It is simple like the outsourcing of the collection work. That is a factoring. Dear students, we will be provided with one of the two information as per the institute publication questions. One, we may be provided that's the loan given by the factor, and another is loan not given by factor. That is the way we have the two types of information. One is that the loan is not given by the factor. If at all the loan is not given by the factor, then in that case, usually it is a simple like the question of the receivable management. When you are required to make a comparison of the in-house management of the receivable with the factoring services, in which we will consider the sales, we will consider the cost, we'll consider the carrying cost, we'll consider the bad debts. Now once you appoint the factor, then in that case with respect to the factoring services, there are two types of factoring services that we have. One is given a name as the recourse factoring services, and another is given a name as the non-recourse factoring services. Like that, so there are two types of factoring services that we have. Recourse factoring services means a factoring services in which the company is responsible for bad debts, and non-recourse means the factor is responsible for bad debts. So once you appoint the factor, afterwards whether the bad debts expenses will be there or not for the company, that depends upon the factoring services. If it is recourse, then in that case, say there will be expense. If at all it is non-recourse, then in that case the bad debts expense will not be there once you appoint the factor. Okay, like this we are required to deduct all the expenses, say once we appoint the factor and with in-house management of the receivable. We'll make the computation of the profit or loss, and the option which is having, say the higher profit will be selected. This is the way we are required to make the computation of answer. This is a normal question that we will have, say as what we do in case of receivable management. We understand that say usually, not every time, usually we will be provided with the information that say we will be able to save the time period for the collection, so there will be savings of carrying costs. Then there will be increase in the sales. Why? Because we are able to focus more on our like the core activities. With that, so we are able to increase the sales. Then there will be savings of the bad debts. There will be savings of the collection expenses, and so on. Information will be given to us. Taking into account these advantages, and of course the cost of the factoring commission. We are required to make the computation of the profit or loss for the present and for proposed. If at all there is a increase in the profit, we'll go for the new one. If at all there is a reduction in the profit, we'll advise the company that say you continue with the existing one. This is the way we are required to write the answer. If at all the loan information is not given, then in that case relatively the answer is very simple. If at all the loan information is given, then in that case how to do answer, let us discuss that. That is, loan information is given. Then in that case how to do answer, let us discuss that. In that case we are required to say understand the question like this. We will be provided with the information that the factor is going to say give loan to the company. In that case, say we will be doing answer something like this. For in-house management of the receivable and for factoring services, we have to make a comparison. Let us say that the information about the variable cost and the total cost have not been given. So in that case what will happen? Listen to me carefully. We'll make the computation of the answer like this. Collection cost. It will be there in case of in-house, it will not be there in case of factoring. Bad debts. It will be there in case of in-house, not in case of factoring, because usually the institute makes an assumption that it is non-recourse factoring services if at all we have not been provided with the type of the factoring services. Then we understand it's the interest payment to factor. Dash, and over here, so the interest expense will be there. Then carrying cost of own funds. Over here, there will be like the huge carrying cost of the own funds, and over here, there will be marginal cost that we will have. Then factoring commission. No factoring commission right now, and the factoring commission expense will be there once you appoint the factor. That is the way we are required to make the computation of the total cost for both the options. And the option which is having the lower cost will be selected. Now this is the final answer that we have. But before we reach to the final answer, there are certain working notes that we are required to do. That is in case of factoring services. Listen to me carefully. In case of factoring services, first of all, step number 1 will be calculation of debtors. What is the amount of the debtors once you appoint the factor? It will be calculated like this: annual credit sales divided by, let us say, 360 days or 365 days or 12 months or 52 weeks, whatever may be, into average collection period. Now, importantly, friends, we are required to take the average collection period once you appoint the factor. That is what you are required to take. And accordingly, we will make the computation of the debtors once you appoint the factor. See, the heading is factoring services. Then step number 2. Step number 2 is calculation of loan amount. What is the amount for which the loan is given by a factor to the company? That is what we are required to make the computation importantly. How it will be calculated? We start with the debtors. Because debtors is indicating the gross blockage of the funds in the business. Less factor reserve. So certain amount will be kept as a reserve. Less factoring commission. Importantly, friends, we make an assumption that the factoring commission is collected in advance. So the factoring commission will be deducted. So we will get amount on which interest is calculated. Then this is the amount on which interest is calculated, and again interest collected upfront. So what will happen? That's the partial interest will be collected, say, on upfront, that is in advance. And then we will get, say, the amount of loan received. So what will happen? That's from the total debtors value, there will be a certain amount for which the loan amount will be received. Suppose the debtors value is 10 lakhs. You have received the loan of rupees, let us say 6 lakhs. Then the remaining 4 lakhs you are required to invest on with your own funds, and you will have the carrying cost of your own funds over here. That is the total debtors value that you have. That is whatever the total debtors value. This is the amount of the funds which you require in the business minus loan amount received. Difference of that is the amount that say you invest with your own funds multiplied with the cost of capital. That is the way we will have the calculation of the carrying cost of the own funds. With in-house management of the receivable, it is the debtors into cost of capital. That is the way we will make the computation of the carrying cost of the own funds. That is what we understand. And we are required to make the computation of the total cost for both the options. And we'll select the option which is having the lower cost. Now, listen to me carefully. Suppose sales and average collection period are same. Even after appointment of the factor, suppose. Then in that case, my suggestion to you is this. Let's say you should go with the step number 1, calculation of the debtors. Step number 2, calculation of the loan amount. Then directly you can go for step number 3 like this. Listen to me carefully. We will have savings of bad debts. If those two conditions are satisfied, we will have savings of collection cost. Then we will have less interest payment to factor. Then we will have less factoring commission. That is the way we are required to make a comparison between the advantages and the cost that we have. Difference of that we will have is the profit or loss. Okay. If at all there is a profit, we should appoint the factor. If at all there is a loss, we should not appoint the factor. That is the way we are required to take the decision. Now, going further, sometimes the question is providing, let's say you are required to compute the effective cost of the factory. Effective cost of factory. That is what you are required to compute. Then how to make the computation of the effective cost of the factoring? Let us understand it. Friends, effective cost of the factoring means we are required to make the computation of the such cost of capital at which the total cost for both the options are same. So what will happen? Step number 1 will remain same. Step number 2 will remain same. In step number 3, what happens at say, this debtors into cost of capital. To this X variable will be assigned. So what will happen? Let us assume that say right now the debtors is 5 lakhs. Then in that case it will be 5 lakhs into X. Later on, once you appoint a factor, then in that case, whatever the investment that say you have made in the business, multiplied with X. In that case, it is 1 lakh into X. That is the way we will make the total cost of the existing, total cost of the new, and keeping both of them same, we will compute, let's say, what is the total cost what is the cost of capital at which the total cost for both options are same. The cost of capital at which the total cost for both options are same is given a technical name as the effective cost of the factoring. Now, effective cost of the factoring is useful like this. Listen to me carefully. Company's cost of capital is to be compared with effective cost of the factoring. If the company's own cost of capital is less, then in that case, should you appoint factor? Question mark. The answer is no. Do not appoint factor. Why? Because appointment of the factor is expensive. If at all the company's own cost of capital is more, should you appoint the factor? Yes, you should appoint the factor. Why? Because the appointment of the factor is less expensive. My own cost of capital is, let us say, 15%, and effective cost of the factoring is 13%. So you should appoint a factor. And if both of them are same, then in that case you are indifferent. By chance, friends, by chance, the effective cost of the factoring comes negative, by chance. Then in that case, whatever may be the cost of capital of the company, you should appoint a factor, because negative effective cost of the factoring is indicating that you get the funds to be used, and at the same time, so you will be able to say reduce the cost. Your cost is also reduced and you are able to get the funds say to be used in the business. This is what we understand. Always remember, friends, that's over here in step number 1, when we compute the amount of debtors, then this amount is blocked in the business not for a certain time period, but it is remaining invested in the business for perpetuity. Let us see the theory questions. See question number A, C and D. All the questions are same. Differentiate between factoring and bill discounting. So what is the difference between the factoring and bill discounting? This is a question which has been asked for approximately 3 times in examination. Next, what is factoring? Enumerate the main advantages. So again the question is with respect to the factoring. What is bill discounting? How does it differ from the factoring? So again there is a question asking about the difference between the factoring and bill discounting. So over here, the financing of the working capital is what we have covered in the working capital management, that is conservative, moderate, aggressive, all those financings. Now as far as the theory chapters are concerned, first and second theory chapters are there. In that, dear students, the important questions are the profit maximization, wealth maximization. The important questions are the debt securitization process, the benefit to the originator, then the participants, originator, then special purpose vehicle, then investors. Like that, so the entire debt securitization process is something which is important. Then we have ADR, we have GDR, bridge finance, deep discount bond, seed capital assistance, methods of venture capital financing. All those are the important questions that we have, say from examination point of view. So I think that we have covered everything in this the revision session, and wish you all the best for examination.
If you like this video, share it with your friends. Subscribe to our YouTube channel to watch more such videos and learn from our expert faculty members. Press the bell icon to get regular notifications whenever we upload a new video. Download NDI mobile app to get complete CA course online. We value your support. Thank you for watching.